distinguished guests, dear colleagues, ladies and gentlemen, it's my great pleasure to welcome you here today at the 9th Annual Conference on Financial Instruments under the Common Agricultural Policy. I'm pleased to see a great number of you here from a great variety of backgrounds and organizations. I thank you all for joining. Your presence here today and the participation of the European Investment Bank and COPA-COGECA is important and encouraging. It shows a strong recognition that in the current climate, our farmers need accessible finance at good conditions now more than ever. After meeting the challenges of COVID, our farmers now face the crisis caused by Russia's aggression in Ukraine, which has provoked sharp increases in energy and production costs. To fully understand how this crisis has impacted the sector, we surveyed more than 6,500 farmers and over 2,200 agri-food businesses across 24 EU member states. The results show that 84% of all farmers in the EU experienced an increase in production costs, but only 20% managed to significantly increase their selling prices. By comparison, about 77% of the agri-food enterprises managed to pass on the increase in production costs to consumers through higher selling prices. This significant difference reveals the disproportionate impact of the crisis in our farming sector. Furthermore, it is not the only crisis faced by our farmers. I recently visited Thessaly in Greece, where I witnessed environmental destruction on a scale I have never seen before. Beneath every floated field was a family business, a vital income and essential supply of food. The financial needs of these farming communities to support their recovery are immense. In the years ahead, our farmers will have to cope with even more environmental and climate challenges. To mitigate and adjust to these challenges, they will need new techniques and technology. They will need to invest and diversify. In particular, our small family farms and young farmers need support to remain viable, to improve their productivity in a sustainable manner, to ensure they get fair rewards in the value chain. To support all of our farmers now and in the future, significant financing will be needed. So I can easily repeat what I said before. Now more than ever, farmers in the European Union need accessible finance at good conditions. Yet just when the financial needs of our farmers are in their greatest, the financing gap in the EU agriculture is the largest. Our farm survey shows that total financing gap for EU agriculture has increased substantially and is now at 62 billion euro. It has almost doubled compared to the average level in the gap in 2017, which was 33 billion euro. If we look into this gap, what do we see? We see 5 of our largest member states, Romania, Italy, Poland, France, and Spain, who account for almost 2/3 of that 62 billion gap. Compared to 2017, we see the gap growing across a number of member states. In Latvia, the increase was 11-fold. In Austria, in Italy, the increase was 7-fold, while in Denmark it was 5-fold. we see that all farmers experience significant difficulties in obtaining money from banks, but the biggest burden remains on small farmers. They account for 38 billion of the total gap. For young farmers, the figure has increased since 2017 to reach 14.2 billion. Long-term loans remain difficult to obtain for all farmers. They account for 58% of the gap, or 36 billion euro. Furthermore, our survey shows that 37% of all rejected farm loans were down to limitations of the bank policy. In other words, the unwillingness of banks to expand their support to agriculture. In the case of young farmers, more than 50% of all their applications were declined due to restrictions in bank policy. The lack of credit history remains a significant hurdle for young farmers, accounting for 36% of the rejected cases. We do see positive news in the food sector, however, where the total financing gap declined from the maximum level of 11.8 billion in 2017 to 5.5 billion in 2022. While this is positive for the food sector, it reveals the unequal treatment of the farming sector by financial organizations. Ladies and gentlemen, in summary, our surveys tells us that the financial needs of our farmers are growing, and these needs are not being met by banks. Securing finance remains an enormous challenge, and if the financial security of our farmers is threatened, the food security of society is at stake. To address this issue and to close the financing gap, we must combine the efforts and resources of our public and private sector. First of all, the results of the survey emphasize the importance of the CAP funding and the relevance of CAP objectives. Let me give some examples. The new Common Agriculture Policy, with support over 350,000 new young farmers, with a total of 8.5 billion euro. This funding is directed towards setting up of farms, the topping up of direct payments, and supporting investments. The CAP is also supporting small farmers. About 4 billion euro, over just over 10% of the EU direct payment budget, will be relocated for redistributive payments. In addition, 5 strategic plans include a dedicated payment to small farmers. Furthermore, about 400,000 farms are expected to benefit from investment support under the rural development pillar of the CAP, mainly targeting on farm productive investments. However, to respond to the growing environmental challenges facing our farmers, we need to ensure that the Common Agriculture Policy has sufficient funding in the years ahead. For example, in light of our recent challenges, a strong agriculture reserve is essential. Member States must also embrace CAP support for preventive and proactive measures that enable farmers to anticipate and adapt to the impact of climate change. For instance, the CAP offers risk management tools, grants for the farm modernization, sustainable and green investments to improve energy efficiency, and support for cooperation activities. Farmers can also apply for short-term measures to alleviate liquidity difficulties, such as support for working capital. Tools such as this will be crucial to help address the financial needs of farmers in the coming years. And among these different tools, financial instruments can play a key role. Under the 2014-2022 period of the CAP, we have 32 financial instruments in operation, which can run into 2025. By the end of last year, these financial instruments have directed over €1 billion in loans to support almost 13,000 farms and businesses. In the new Common Agricultural Policy period, 12 member states have programmed financial instruments into their national strategic plans, amounting to 997 million of total public support. 6 member states have programmed financial instruments to provide installation support exclusively for young farmers, accounting over €88 million. In the new Common Agricultural Policy, member states also have the right to establish preferential rates and conditions for target groups, such as young farmers. They can design financial instruments to support young farmers in the purchase of land with no restriction on size, and they can set up financial instruments to support stand-alone working capital and risk management, for example, young farmers experiencing production difficulties. We need member states to use these possibilities to their full potential. By making the most of financial instruments in the Common Agricultural Policy, we can make positive changes to the market. As I have mentioned, European Union banks' requirements on farmers are heavy and lack flexibility. Many farmers who apply for loans are rejected, while those who are accepted face market prices and high interest rates, which can cause further problems. Our data shows that between 2010 and 2021, the share of farmers with financial debt has increased from 27% to 35%, and that 80% of this debt falls under commercial loans. We also know that there is little competition in the market, as not enough banks specialized in agricultural finance. In numerous member states, only 2 or 3 banks account for a significant share of the overall agricultural financing. And here is where our financial instruments can intervene and correct the situation. With financial instruments, member states can offer farmers easier access to finance at reduced interest rates, with longer maturities, with much lower collateral requirements, and accompanied by working capital support. Outside of financial instruments, Common Agricultural Policy interventions can also encourage the private loan market. In 2022, about 29% of all farm loans in the EU were linked to CAP support. This is a significant share, which indicates that the banks feel more secure when projects are backed up by CAP payments and grants. To conclude, we must build a new financial environment to meet the current needs and future challenges of our farmers. For this to happen, we need everyone, the European Commission and the European Investment Bank, our member states, and our private banks. We need to use the tools at our disposal. We need to provide strong interventions in our Common Agricultural Policy strategic plans. We need well-designed financial instruments, and we need to raise more private funding for the sector. Ladies and gentlemen, I have presented a number of different figures which you may or may not remember, But if you take anything from my interventions today, let it be these three messages. It is the time for banks to open their doors to farmers. It is a time for member states to open new possibilities through CAP interventions and financial instruments. And it is time for all of us together to close the financing gap for European agriculture. With this, I wish you an interesting conference and many fruitful discussions. Thank you.
Now I'd like to pass the floor to Gelsomina Vigliotti, the Vice President of the European Investment Bank, for your opening remarks.
Dear Commissioner, dear guest, I'm delighted to be with you here today, representing the European Investment Bank and reinforcing our contribution to the role of financial instruments in supporting more common agriculture policy investment along the lines of what the Commissioner has just told us. During the past 5 years, the EIB has provided around 25 billion euro of co-financing to the agriculture and bioeconomy sector inside the European Union through direct lending to private companies, cooperatives, or public entities, as well as indirectly through partner banks and other financial institutions. Agriculture and bioeconomy are key lending mandate and advisory priorities of the EIB Group. It is a key component of our role as the European Union Climate Bank, helping to ensure security and sustainability of food supply. We also welcome and are specifically supporting the Commission's REPowerEU initiative and its objectives of reduced fossil fuels dependence and diversification of gas supplies. These efforts require significant investment also in the agriculture sector, for example, in bio-based fuels. Investment needs in the sector are significant. At today's conference, as the Commissioner already said, we will present the results of a recently completed FICOMPAS survey of farmers and agribusiness. This survey, which is a follow-up to a first survey published in 2020 and covered around 9,000 farmers and agribusiness SMEs, shows that investment needs and therefore financing needs are growing. Access to finance is still a challenge across the Union. In some countries, more than others, and especially amongst small and young farmers. It is positive to see as well that farmers also recognize the climate mitigation and adaptation challenge with plans to make more climate-related investment over the coming years, particularly in the fields of energy efficiency and renewable energy production. A parallel survey of a selected group of banks active in the sector also confirmed these findings, signaling that more financing could also be provided to the sector with the support of credit guarantees and/or longer-term funding. The sheer scale of investment needs in the sector means that we need to be smarter in how we use the scarce public funding available. We need to leverage more private sector investment, and this is where financial instruments have a role to play. Working with our colleagues in DG Agri, through the FICOMPAS advisory mandate, we have been working jointly to see how more financial instrument usage can be stimulated and how it can be combined with financing from the EIB Group, commercial banks, and other investors. A number of member states and regions have so far entrusted the management of their EAFRD and national resources to the European Investment Fund, which is part of the EIB Group, mainly through the provision of guarantees to more than 30 financial intermediaries. This funding is leveraging more than 3.6 billion euro of investment firepower into the sector. We have also worked with partner institutions like the national promotional banks to do more together. You will today hear about the example in Ireland that leverages financing from the Irish government, EIB Group, the Strategic Banking Corporation of Ireland, Irish banks and specialist financial intermediaries to support farmers and agribusiness in the country. Connected with these, you will also hear about an innovative online tool developed with the support of the EIB advisory to make it easier for farmers, businesses, and the partner banks to assess the eligibility specifically of their climate-related investments for this financing support. Thanks in part to the FI Compass survey and outreach work we did earlier this year, we have identified and taken forward an increased number of lending operations via our partner banks to the sector. The head of our financial institutions lending department will tell you more about the pipeline of 1 billion euro of financing that we plan to sign with these banks in the coming months, leveraging more than 2.5 billion euro of financing to the sector. All of this is good news, but it's clearly not enough. More can be done with financial instruments, and we hope that what you hear today regarding the results of the access to finance surveys and the numerous examples of best practices will convince more of you as managing authorities to come along on this journey with us. We hope that you will make the most of the flexibilities in the EAFRD regulation to support more use of financial instruments, which includes the ability to finance working capital, land purchases of young farmers, and the combination of financial instruments with grants. But you will not be alone in this journey. Our EIB advisory colleagues, along with DG Agri, stand ready to support the managing authorities that want to exploit these new opportunities. Through FI Compass, we can offer more tailored support to those managing authorities interested in exploring the feasibility of such instruments and combinations of funding, building on the results of our detailed surveys and working knowledge of the instruments. Please do get in touch by reaching out to one of the many EIB advisory or DG Agri colleagues which are here today. I see them on the first row, so please contact them and speak with them. They have things to say relevant to you, as well as to us, since we all together, pursue the same goals. Let me now close by thanking you, Commissioner, for inviting me to be here today, signaling our joint commitment to the cause, and let me wish you, dear participants, a productive day of financial instrument knowledge sharing and learning. Thank you very much.
Now I'd like to kick off with the conference, and to do so I'd like to start with the viewpoint from the European farmers and agricultural cooperatives on access to finance, and to do so I'd like to welcome Pekka Pesonen, who is the Secretary General of the EU Farmers Association, COPA-COGECA, to the stage.
Thank you, Natasha. I feel that I'm probably one of those armchairs in this event, a bit of a furniture already, and I'm very proud of that. Because basically this is crucially important topic for European farmers, and in particular my organization that I represent, COPA and COGECA, European Farmers and the Agricultural Cooperatives. Ladies and gentlemen, dear Commissioner, dear Vice President, Natasha, dear friends, it's indeed a good time for us to reflect today how, for instance, in our organization, how we relate to the matter of the day. We represent European agricultural organizations, farmers' organizations and cooperatives, and their organizations all across the EU. We are there from bees to trees. We are there for small, medium-sized, big farms, big cooperatives, small cooperatives, or other farmers' initiatives when it comes to economic exercise. It's an honor for me to be able to address you today, and in particular when we already have the 9th European Conference in highlighting the need to access to finance, and especially for farmers and their cooperatives. I certainly would like to thank the Commission, European Commission, and the European Investment Bank for your strong support to this initiative, not only to the event itself, but the actual policy behind it. We are living challenging times in the EU and in the agri-food fiber value chain. And I don't have to go through those details that you are so familiar with. They have had a major impact on European farming community, and this impact would only increase. I would only point out a couple of most recent, and that would be the consequences of the Russian aggression against Ukraine, the consequent inflation in our input sectors, and consequently also the whole of the food chain. Food inflation is the biggest challenge that we face in agri-food chain in the EU at the moment. The situation on the ground cannot be considered business as usual as a consequence. Indeed, it feels like we are shooting targets from a galloping horse, and it's really a rocky ride. In addition, starting this year in January, our farming sector had to adapt to the rules of the new CAP. This meant implementation and deployment of the national strategic plans. In addition to the challenges at farm level, our national administrations have experienced delays and other difficulties in many member states. But our members, farmers, foresters, and their cooperatives remain in the forefront in proposing and implementing solutions, finding opportunities for producing ever more sustainably to ensure food security under increasing demand for food, feed, non-food outlet production, and climate change pressures. And of course, this list only extends. We talk about biodiversity, we talk about some other issues of societal concerns. They do, our farmers, foresters, cooperatives, they do this based on a holistic approach of the 3 pillars of sustainability and, of course, economic, environmental, and social, and they all have to match these objectives. And all this while also contributing to reduce global food insecurity in the world that, according to the United Nations forecast, will reach 9.7 billion inhabitants by 2050. In the light of the most recent developments, it is obvious that we must ensure affordable food in response to our concerns in ever-rising cost of living. This is something that we were very pleased to see that our Commissioner pointed out several times in his public statements. But I was quite bitter, it was quite bitter, and we were quite disappointed to see that some other representatives of the Commission top management were not that concerned about the food security. They don't say that anymore. But make no mistake, farmers in the EU are committed to more sustainable production systems and practices. To the EU decision makers, we would call for, first, improved farmers' income and more equal positioning in agri-food fiber value chain. Secondly, and I'm so pleased to have seen my colleague from Young Farmers, Marion is somewhere in the room, identify yourself that I can actually point out that you are an important stakeholder here. We need to address generation renewal. In fact, successful number of young entrants to the market, to agriculture sector, is a good indication of successful policies of the EU. Thirdly, investment in innovation, new technologies, and the transition to ever-green economy. Fourthly, development and implementation of more performant and responsive market and risk management tools to increase our operational resilience. Then, ensuring our competitive and services, and this is particularly urgent now with the current situation in Central Eastern European Union member states experiencing high volumes of imports of Ukrainian agricultural commodities. This is where we need the European Union to act. We need not only member states, not only the private operators, we need the Union to show what it's made of. In 2019 and 24, legislature has been the one to set the targets while dealing with the polycrisis context. All too often, the means of reaching those targets have been rather modest. Sorry to say. The most difficult part is yet to come, though, as in the coming months we will be moving from political regulatory discussions to implementations on the ground. But it still remains to be seen what the Commission President, Madame von der Leyen's speech in mid-September pointed out, and how that call for dialogue, strategic dialogue, would work for. What would it mean in practice? We certainly welcome this. And the Commission President's words responded to our long-standing call on the need to focus more on an open dialogue and less on polarization. In COPA-COGECA, we are also convinced that agriculture and nature protection can go hand in hand, and we welcome the announcement to open strategic dialogue on the future of agriculture in Europe. Whilst waiting for further details and confirmation of this important step, where Commissioner Wojciechowski's team is very much involved, we believe that any dialogue must start from the reality faced on the ground by farmers, foresters, and their cooperatives. I should say that the slide that Natasha showed us, in fact, in this room too, we should have the sixth language, translation to the farmer's language. What does it mean in practice, what we discuss here today? Our strategic role in ensuring food, fiber, energy, and other vital services is more than obvious. This must be at the center of the discussions. The timing of this dialogue is also quite important, since the new legislature will start next year after June elections. And let me also make it clear, we must discuss how to improve our sustainability, societal resilience. We simply cannot abandon the Green Deal. We need to make it work. We need to make it successful, and that's where the farmers and our sectors will come handy. But it must make sense not only in the minds of the Brussels white-collar bureaucrats like us, but to those millions of dedicated people that are supposed to put it in practice and while doing it, making a living out of it. The new legislature, which will start next year, must identify what future we want for the New Deal for European Union agriculture. We need to go further to improve the dialogue with farmers and foresters, and the EU seems to talk about restoration, but then most of these restoration initiatives are outside the scope of agriculture or forestry sectors. It's very much about nature, it's about traditional landscape. Even, Commissioner, if you allow me, I would point out that you have pointed out some restoration of structures in agriculture. I'm not sure whether we can actually implement that, but nevertheless, in the words of one of our member organizations, should we not set up an Agriculture Restoration Act by giving the sector attention that it deserves? We hope that during the next EU legislature, the EU institutions put in place a true enabling framework for the farmers' transition, fit for the strategic role of farmers and agri-cooperatives to ensure food security and affordability into the EU and beyond. We need three issues. We need future, solid, sound, predictable for a union multi-annual budget, no surprise. But let me address this bit more detail. The reality is that the ongoing war is depleting our margins in the EU budget. And the reality also is that we are not going to double the CAP budget. We are not going to double the EU agricultural expenditure through taxpayers' contributions. We need to make these investments and the new allocation of our resources truly market-oriented. And I welcome the Vice President, Investment Bank Vice President calls for this. Let me put it also very bluntly. The famous NGOs calls for sustainable investments in the past have proven to be useless. The commitment was never there. We did not benefit from the consumer reaction where the sustainability efforts of the farmers would have been rewarded. Organic, unfortunately, was a very good example of that. And let me be clear, we do not like organic dwindling. We supported the 25% initiative to the land use. If we go for the grocery share the same, we have to be competitive in agriculture. And those two things, these two initiatives and objectives must go hand in hand. You cannot be at level of 25%, 30%, or whatever the percentage, if you are not competitive in the eyes of the consumers. This competitiveness was never there, consumers, no matter what the NGOs said. They failed to deliver. Second, we need fair trade. We need international rules to govern what we need in convincing our trading partners. We had very good talks with our North American colleagues in US, Canada, and Mexico, and we in fact agree in most aspects. We need to be ambitious in the EU, but we need to make sure that our trading partners play along. Then third element is that we need to analyze what the proposed initiatives would mean on the ground. The famous impact assessment must be there. So the next 12 months will be extremely important for us. Believe me, we are very motivated, we are very engaged with this process. We are supported the EU, we are supported the institutions, and we need to make it a success. But it is very much about also how we organize ourselves to remain strategically autonomous, which has been one of the key words in the past. And in that, access to credit and finance is crucially important. During the past few years, we were used to reasonably low interest rates and affordable financing. Increasing inflation, European Central Bank higher interest rates, and volatile international politics have been seen an additional burden to the necessary investments that we all need. As a consequence, we have seen historically low levels of new entrants, young men and women to agriculture sector. It goes without saying that the need of affordable finance is becoming a major driver for future. Instead of building administrative EU barriers and creating non-marketable cost of compliance, we must incentivize, not hinder, investments to our primary sectors, especially in agriculture and forestry. Also, we need to keep in mind other primary sectors such as fisheries and agriculture. And we need to say this out loud. Forgive me for saying this, but the overwhelming feedback that we receive from our members points out that the European Union is seen more as an obstacle than an enabler. And like the Commissioner and the Vice President pointed out what we have done, while this may be necessarily the case, this may not be the truth, but we need to take this seriously and we have to address this head-on. We have a number of developments that are dangerous for the European Union future, especially when it comes to market imbalances and how the European Union responds to them. And a part of that management of, for instance, once again, Central Eastern European member states, is how European Union is going to address them. What is the role of the EU parallel to the member states in trouble? And this is where financial instruments play a crucial role, as we have so many times said this morning. I completely agree with the Commissioner's 3 points. We need to address the sectors such as the banks, that we would encourage them to come forward with the primary sector investments. It must be, of course, lucrative for them financially. Once again, the market orientation must be there. Member states must support the tools that have been made available, and we have to close the financing gap. But be it during this current planning period or the next one, financial instruments need to continue to be available for our sector. Ladies and gentlemen, I very much still believe that, like the EU itself, financial instruments make a difference. Thank you very much for your attention.
We do have a few moments for questions for Pekka. Would anybody like... We have a question here. Someone could bring a microphone.
Or if you disagree.
If you can just introduce yourself and try and keep your question nice.
Thank you very much indeed. Good morning. Bonjour tout le monde. My name is Ciprian Alic and I'm coming from Romania from the National Credit Guarantee Fund. But recently, 2 days ago, I was invited as a speaker at a very important conference on agriculture in the Parliament of Romania, which regroup a lot of specialist researchers, but in the meantime, representative of farmers, consultants, and so on, and politician, high-level politician. Having in mind that we have the pleasure to participate with His Excellency Commissioner on Dottoressa Vigliotti. And Pekka, I remember you from long time ago during the period of time when I work in DG Agri. But the message is the following. The common agriculture policy, it's the oldest policy of the European Union common policy. More than 55, 60 years ago started. During all this time, we work on several reform of the CIP. But the message from the Romanian audience 2 days ago from the Romanian Parliament is we need much more flexibility because today we are living in a different period of time. When we start to work on the common agriculture policy was a normal time. And we supposed to have a normal future. But today, dear Commissioner, you are coming from your native country, from Poland. I'm coming from Romania. There are a lot of other colleagues here from the very affected countries and rural and agricultural and agri-food sector, very affected, crisis after crisis. What we need is to be flexible, dear Mr. Commissioner, with all the member states which intend to adapt their measures on the national rural development plans to the actual challenges we have, because you know, and I don't want to discuss more regarding how difficult it is to be a farmer today in Romania and in Poland, dear Mr. Commissioner.
Okay, so
also, and I stop here,
your question? Yeah,
it's the same, yeah, what is the situation, what is the opinion of the Commissioner? And secondly, we discuss about Green Deal. Yes, of course, Green Deal. It's correct. 2030, 2050, we have the challenges and the steps forward to fulfill. But we are living in a different period of time today. Let's be serious, dear colleagues and high European officials.
So
Thank you very much indeed, and
you.
I hope I was not very impolite, dear Commissioner.
Thank you. Pekka, the flexibility of the cap, the age of the cap, I've heard it referred to as a legacy policy, etc. What are your viewpoints on what we've just heard there?
Well, the reality is that we have to mix, bring together common policies, avoidance of distortion competition, and those flexibilities. And now with the national strategic plans, we have a moment of truth. We have to prove at member state level that it works. And we know that the commissioner has been working on this. So like in your native Romania. Now the big question remains that how much difference does the national strategic plan make to the Romanian farmers in relation or more rigid on the old system that we had? The burden of proof is actually now at national level. We felt as COPA and COGECA that we should go for this when Mr. Hogan in the previous commission proposed this as a general approach. because this was what our members were calling for, also from Romania. But it is important that now we demonstrate that these national strategic plans can work within the general framework of the common, truly common agricultural policy. We believe that this can be done, but I'm absolutely convinced that it's not going to be easy in all these details that you mentioned. And that's why we point out that the European Union role in relative terms now, especially with the market disruptions that we have had in some Central Eastern European member states, are of great relevance for the European Union to demonstrate what we can do jointly. And especially the common market in this respect is important. And of course, the infrastructure investment, like I said.
Excellent, thank you. Yeah, Commissioner, would you like to have an intervention? We'll just get you a microphone, one moment. Oh, okay.
Commissioner.
Very kind, thank you.
Thank you very much for this question, and it was not planned that my answer, but the question was very interesting and about the flexibility in the common agricultural policy. First of all, I'd like to mention that this reform, common agricultural policy reform, last reform, this is the biggest reform in the last 3 decades, last 30 years, but common agricultural policy in this current period is much more flexible than in the past. First of all, we have the national strategic plans, national, and we have the common agricultural policy, common objectives, common the system, common market, but member states have much more opportunities to define their own strategy, how to achieve the common goals of the common agricultural policy. And we are flexible that the strategic plans, for example, the eco schemes, we decided, it was the legislative decision that minimum 25% of the national envelope for the direct payment should be spent for the eco schemes. But what kind of eco scheme, what the practices will be recognized as the eco schemes? It was a decision on the national level, of course approved by the Commission, but member states proposed the eco schemes. Like country which I know best, my home country Poland, there was animal welfare, for example. This is very big part of this envelope would be spent for the improvement of the the animal welfare standards, which is very important. And also we are open for the amendments to the strategic plans. During the COVID crisis, there was also the flexibility in our reaction, the state aid, for example. This is not the generally good solution, state aid, because we have the common policy, common market, but in this exceptional situation, we accept the state aid to use this instrument, state aid, like the countries directly affected by the Russian aggression in Ukraine, but the problem with the grain import from Ukraine. It was market shock in the frontline member states, and the Commission decided first time to introduce the local regional ban for direct import of grain to the 5 member states affected by this shock on the market. And also Commission approved the state aid for the affected farmers, which it shows that, like Romania also, that is the country which, the Romanian role in the transit of the solidarity lanes is very important in this difficult situation, yes. But I think that we need flexibility, of course, because we have different challenges in European agriculture. We have this different challenge, like in Czech Republic, where is the average size of the farms is 130 hectares. Different in Romania, where is the 5 hectares average size. Different in France, 50 hectares, etc. Yes, flexibility is needed, and finally speaking, summarizing that our common agricultural policy in the period 21-27, practically 23-27, because we have the 2 years transition period, is much more flexible than in the past. Thank you very much.
Thank you very much. So I'd like to welcome to the stage Sean Farrell, who is Head of Product Development, Marketing and Research at the Strategic Banking Corporation of Ireland, and also Francesca Epifania, who is the Mandate Manager at the European Investment Fund. So welcome to the stage, and Sean, I will turn to you first for your presentation. Thank you.
Thank you and good morning to everybody. Firstly, at the outset, I would like to say thank you for the opportunity to speak to you this morning about how the Strategic Banking Corporation of Ireland is helping to support farmers in Ireland and partnering with other agencies, including European agencies and the EIB, to facilitate this support. At the outset, to try and put this into some context, we in the SBCI are Ireland's national promotional institution. We're an agency of the Department of Finance. Our mission is on the slide, but to put our objectives into context, we've got three main priorities. Firstly, to increase access to finance for SMEs and farmers, to promote sustainability, which is very relevant in the current context, and to enable SMEs and farmers to grow and prosper. And we do this in two main ways. Firstly, we supply liquidity, so wholesale liquidity. We don't lend directly, but we do work with on-lenders and banks, and increasingly non-banks in the Irish market, to supply lower cost liquidity, which can then be provided through to farmers and to businesses. And secondly, we provide guarantees, risk-sharing instruments, so combinations of state guarantees, but also guarantees which we've sourced from the EIF, which we'll hear about today, and developed in partnership on a bespoke basis with EIF and EIB. On the slide, you'll see the sectoral breakdown of the support that we've provided since we were set up back in 2014. And agriculture remains the sector which has benefited to the greatest extent from the guarantees which is supplied. Over 800 million euros of funding through a combination of liquidity and guarantees to the agri-sector over the past 10 years or thereabouts. What I'm here to speak to you today about is the Growth and Sustainability Loan Scheme, which is our most recent risk-sharing guarantee scheme, which we developed in conjunction with the EIF and the EIB, and with support from Europe, and also support from government departments in Ireland. And to give a little bit of background, without getting into too much detail about how we develop our guarantee schemes in Ireland, we use off-the-shelf guarantee products, and in the past we've used COSME, we've used Inofin, we've used the EGF in conjunction and with the support of the EIF. We've also developed bespoke guarantees, which have enabled us to provide uncapped guarantees through to banks, and in return for those guarantees, we ask the banks to lend in ways which support some of the challenge which we've already heard about this morning from some of the speakers, including the Commissioner and the Vice President from EIB. In terms of the difference that those guarantees make, they're multiple, but they do result in lower cost lending. They result in higher degrees of unsecured lending, and critically, they enable us to encourage banks and non-bank lenders to provide longer-term lending which wouldn't otherwise be available. In terms of the Growth and Sustainability Loan Scheme, this is focused on long-term investment lending. I'll go through the features in a moment. It's a 500 million euro scheme. It's available to farmers, to fishers, and to SMEs. So we've found that the greatest benefit is to develop a large scheme which is available to SMEs and to farmers, and that makes for wider penetration and distribution across our banks. It's obviously supported by government, and it's aligned with overall policy and the taxonomy, because this scheme has a minimum requirement of 30% of its lending to go towards climate action and environmentally sustainable purposes. And it's distributed through our on-lender network. So as I said, we ourselves don't lend, but we work with our lenders to provide funding through to the end beneficiary. In terms of the features that are available under this scheme, I think this is what's really important in terms of the farmers and businesses who want to access it. The loan amounts are wide and varied, from 25,000, which is very relevant to small farmers, up to 3 million euros for some large-scale investment, with loan amounts from between 7 and 10 years. And the reason that we have that minimum 7-year term is because this scheme is targeting the investment gap, which requires longer-term funding to facilitate longer-term investment. The fact that we provide a guarantee through to the banks in question and the non-bank lenders who we will have participating in this scheme means that they need to provide a reduced interest rate from what they would ordinarily charge to the farmers. And in addition to that, because 30% of this scheme needs to be devoted to climate action and environmentally sustainable measures, for those loans which support those types of measures, there's an increased reduction in interest rates. So there's a further reduction in interest rate of a minimum of 25 basis points. And the other point, and young farmers have been mentioned here a couple of times already today, is that all loans that go through this scheme, up to €500,000, are available without the requirement to provide any security. So without the requirement to pledge land, to provide personal guarantees. And we have found that as young farmers are looking to embark on their career in agriculture, they have tended to do that in the first instance quite often on leased land where they don't have the opportunity, don't have the collateral to pledge. So the availability of unsecured finance is really, really important. In terms of the features that are available through this scheme, they're wide and they're varied. Business expansion, climate action and environmental sustainability measures, and in the few minutes that's left to me, I will focus on those. Setting up new businesses or new establishments, purchase or acquisition of equipment, machinery, premises improvement, intangible assets, products, services. So ladies and gentlemen, I guess the key point here is that it's a very broad range scheme. The key point is long-term investment with a very significant focus on environmental sustainability. And to quickly give a couple of words in terms of sustainable farming in Ireland and the eligibility that we're applying to this scheme for the minimum 30% aspect of it, Irish agriculture has over 135,000 farmers with a real focus on growth. We've seen significant growth in output over the last number of years and a clear focus in terms of government policy around supporting that growth with a drive towards increased sustainability and sustainable practices. And this scheme looks to support that in a couple of different ways. For a farmer who wants to access the climate action element of this scheme, there's a couple of different ways of doing so. Firstly, if they are an organic farmer, then they get automatic access through to the scheme. Secondly, if they're participating in two of Ireland's eco schemes, being Acres, which is a farm sustainability programme where farmers decide to adopt a number of measures that are environmentally supportive, where they're participating in what we call our Origin Green, our overall sustainability programme, which has evidenced reduction in CO2 emissions, then those farmers get automatic access to this fund. If, however, they're not in those schemes and they still want to access that element of the fund, we've worked very closely with the EIB to develop a green checker that's specific for Ireland, and using EIB's green checker tool and working with the advisory hub, who have been really supportive in the development of this from an Irish context. So the customer journey, the farmer comes to the SBCI. We don't have time to do a demo here, but I have included some screenshots of how this works. They apply through to us for eligibility before they then go to the bank. And the reason that we've done this is because we want to take care of the elements of this journey that can sometimes create blockages, challenges at bank level. And in so doing, we provide an eligibility code through an online journey to the farmer, who then brings that to one of a number of on-lenders or banks who are participating in the scheme. They then complete the credit analysis, they provide the funding under the favourable terms which I listed on a previous slide, and then they look after the rest of that journey. So in terms of the growth and sustainability scheme, for those farmers who are looking to apply for a loan under the climate action banner, they come to our hub, they fill out some very basic details, we look after the state aid elements, and then they go through to the EIB Green Checker. There's a link built in the background between the Green Checker and the SBCI hub, and the lenders also have access into that. So we're trying to make this as digital, as sustainable a journey as possible. The various different measures which are covered through the Green Checker are listed on the screen, so ones that farmers themselves will be very familiar with. What's not listed there as well is the potential for energy generation. And in Ireland, we've seen big adoption of solar panels, particularly amongst dairy farmers that are looking to reduce their overall energy levels and consumption, and that's also eligible. So again, for the farmer, they come onto our website, they click through to the Green Checker, they meet a welcome page like this, which asked them a couple of questions, and if you can see what's on the slide, we talk about a 2 to 5 minute journey, which is important. And again, this was developed in conjunction with the advisory hub and with a lot of consultation both with ourselves, but also with the Irish government departments and agencies like Borbia and the Department of Agriculture, which was really important in terms of being able to make it broadly applicable. I've given one example of how a farmer could come onto that website, onto the green checker, fill in some details for solar panels that they would look to be putting onto their farm buildings. On the right-hand side of the screen, you'll see where that particular investment is considered EIB green. There's an estimate of the level of CO2 savings that's going to be generated on an annual basis. And that report is then available to the farmer and is also sent back to us within the SBCI. We share that with the bank, and that's available to the bank so they know that this farmer is applying for this measure, which they will then covenant to undertake, and we have a record of what is intended and what has been undertaken as part of this portion of the scheme. I'm slightly over time. I could speak for much longer in terms of this particular scheme. It follows on from a number of successful investment schemes which we have developed in conjunction with EIB, and we're very excited about the potential for this scheme to allow Irish farmers improve and increase their sustainability and plan for the future. Thank you.
Thank you.
Good morning. I will do a very quick introduction of myself. I'm Francesca Epifania. I'm a mandate manager at the EIF, which means I work in the team that is in charge of cooperating with managing authorities in order to set up financial instruments. Today we will talk about supporting agriculture through national schemes. We'll go over 3 topics: the structure of the financial instruments behind the scheme, the cooperation between institutions, and then the policy angle, how we're supporting farmers and green investments. So as you can see from this slide, the structure of the financial instrument behind the scheme is a very complex structure. You can see that we have 3 columns in this graph. And they are, if we read them from left to right, we see that how the resources are used until what is going to the final recipient. So the key message is that it's a sophisticated product and is complex. But it's thanks to this complexity that we can achieve high efficiency. What do I mean when I say high efficiency? I mean that we can leverage resources from the managing authority, from the Irish government, and we can go to market with much more resources. So the Irish government, through the Department of Enterprise, Trade and Employment, and the Department of Agriculture, entrusted the EIF with 73.3 million euro. And we went to the market with this growth and sustainability loan scheme that Sean just mentioned, with the possibility to give loans to the eligible final recipient for up to 500 million euros. How was that possible? With the setup of this complex financial instrument, where basically we pooled resources from the Irish government, who participated as offering the first loss piece, then the EIB participating as a mezzanine and senior investors, and the EIF participating as a senior investor. With these resources, we were able to, we will generate a portfolio of new guarantees by SBCI for 400 million euros. SBCI will retain part of the risk, 20%, as the guarantee rate is 80%. And with these resources, we will take a portfolio of new loans for the eligible final recipients, which are farmers, fishers in the agriculture sector, and SMEs in other sectors. The complexity of the instrument is also clear by the legal structure behind it. EIF has entered 3 legal contracts: a funding agreement with the managing authority, a risk cover agreement with the EIB as an investor, and an operational agreement which took the form of a counter-guarantee agreement with SBCI. And then on top of this, there are all the contracts that SBCI entered with the financial intermediaries. We've been able to support agriculture sector through national schemes, and we will be able to keep supporting them thanks to the cooperation with the Irish government in the forms of the department that entrusted the EIF to prepare and work on these schemes, the cooperation with the EIB and the cooperation with the Irish MPI, the SBCI. This cooperation is strong and ongoing and is at the basis of all the instruments that we've done through time. So we started 5 years ago with the Future and Growth Loan Scheme, which was very successful. We started with going to the market with 300 million euros, and then in much less than expected time, the instrument was fully absorbed. So the government decided to deploy more resources, and the scheme was increased to 800 million euros. We then went for a second generation of instrument, the Growth and Sustainability Loan Scheme, which builds on the success of the Future Growth Loan Scheme. This scheme is the one we mentioned before. We look at the structure, and is the one that Sean mentioned. This scheme has an innovative aspect comparing to the previous one. It has a target to do 30% of the loan in green investments or going to green SMEs or farmers, organic farmers. We'll see more about that in the next slide. And then we have another scheme that will be targeting households to support them to do renovation works for energy efficiency purposes. So the basis of all of these, there is a strong and ongoing cooperation. We see how the resources deployed are increasing over time, and we see how also the complexity of this instrument is increasing over time, as well as the policy focus. In this slide, I want to show and give you 3 messages. The first one is the support to agriculture. So with the very successful scheme, the Future Growth Loan Scheme, which was a generalist product. It was not specifically targeting agriculture. However, under EIF products, agriculture, forestry and fishing industry is always fully eligible. And with that instrument, we managed to have 22% of the resources in terms of the disbursed amount to the final recipients going to the agriculture, forestry and fishing industry. With the second generation of the instrument, with the Growth and Sustainability Loan Scheme, we are actively targeting a 30% of green loans, meaning that these loans, they have to support green investments, green SMEs, or green farmers, which basically means those farmers that Sean described before, the one that have a specific eco-label, or organic farmers. It was very important to define who are these green farmers, and it would not have been possible without the support of the EIB advisory. So this brings me to the third item in this slide, the support of EIB advisory. They helped us, they were actually key in defining the eligibility criteria for the climate action part of the Growth and Sustainability Loan Scheme. And they didn't just stop in helping us defining the eligibility criteria, but they've also went a step forward and developed the IT tool that we saw before that helped the farmer assess whether his investment qualify for this green investment. The tool is backed by advanced technology and a complex infrastructure, but yet is very simple to use. We saw the screenshot before in the presentation that Sean made, and it's very innovative and extremely helpful tool. So to add to the fact that the key of the success of these schemes was the cooperation, we can also mention that the cooperation with the EIB advisory was also key for these schemes. And on this positive note, I conclude, and thank you very much.
It is impressive to have that tool and to have that additional amount of funding available, but what is the net interest benefit to the farmer if you sort of exclude the availability of funding, the accessibility of funding, considering also current interest levels? Thank you.
Absolutely.
So the way we recruit or invite applications for what we call sub-intermediaries or banks to distribute the lending for us is determined in no small way by the extent of discount from their existing rates which they will apply. So we run a competitive process. We invite tenders for allocations under the schemes, and we apply a minimum discount of minimum of 1% from their standardised lending. And thereafter, the greater the extent of discount that's provided, that has an influence on the overall extent of the fund which they receive. So the discount does vary depending on the lender, and in Ireland, the funding base between banks and non-banks is quite different. Therefore, that impacts the rate per lender. So in that context, that's the level of discount. Right now, we've launched this scheme quite recently, and the rates which are available to farmers at the moment vary depending on the loan amounts in question. But for loan amounts less than 250,000, interest rates are over 5%, between 5 and 6. But for loan amounts above 250,000, rates can be at 4% or even below, given the level of deposits that are available through Irish retail banks currently. But they're variable rates, and they will move as the wholesale markets move.
Excellent, thank you. Hope that answered your question. Do we have any other questions? We have a question here. Yeah, get the microphone.
Yes, good morning, Nivelino from DG Agri. I have a bit more general question. There is always the debate between subsidy and grants and loans. Based on your experience and given these quite impressive amounts, what's the situation in Ireland? I mean, how likely is a farmer to go to a bank to ask for a loan? What's your feeling about it? Is there a kind of a demand from the sector, so huge demand for better conditions? And I think the key is probably that it's an unsecured loan up to 500,000, so you give an opportunity for somebody to really start on a kind of a more secure basis compared to approaching banks directly. That's my first question. And my second question is, you mentioned young farmers. How is this developing in Ireland through the perspective of the instrument? Do you approach the young farmers? How you communicate your credit scheme to them? How do you try to attract them to come and benefit from it?
I'll deal with the second part of the question first, if that's okay. So on the young farmer element, we rely to a certain extent on the banks who are engaging with the customers, with the young farmers and with all farmers and businesses, not just farmers for distribution of these schemes. So they help to promote the scheme. We also engage directly with the farm organisations, including the Irish Farmers Association, who have young farmers as members, and we promote the scheme in that way. For young farmers in Ireland, traditionally there was a challenge around that lack of security or their ability to provide security, particularly where they wanted to start farming and where they didn't own their own land. And traditionally, livestock hasn't been used as security in an Irish banking context. Therefore, the feature of this scheme, whereby up to 500,000 euros is available without security, is considered really, really important for all farmers, but particularly for young farmers where they don't necessarily own their land. So that's how we try and communicate the message through farm organisations, through the banks, and ourselves through our own media channels. Young farmers and average farmer age in Ireland is it's a feature that's common across Europe. We have seen, particularly with the growth of dairy since milk quota abolition, an increase in young farmers in that sector, but average farm age remains an issue. And that's why we're trying to use incentives like this to try and promote the increase in young farmers. The other question that you mentioned previously, I think related to is it the security elements? Can you remind me of the previous piece? Yeah. So yeah, of course. Yeah. So farmers are very positive about low interest unsecured lending. They're also very positive about grants, so they like both. they haven't expressed, certainly to us, a preference for one versus the other. That's probably a conversation for the Department of Agriculture rather than us as a policy delivery agency. But the leverage effect of the funds which Francesca spoke about being pledged by the government department, that being able to leverage a larger loan fund, and that then in turn leveraging a greater degree of on-farm investment, would suggest that there's very good value in terms of using government funding to support a loan scheme, given the leverage and overall investment impact. But at an individual farmer level, I wouldn't be able to position a view as to one versus the other.
We're just coming to the end of our time, but Sean's been very in demand. Francesca, I don't know if you have anything that you'd like to add about what we heard, or would you like to maybe add a comment?
No, thank you very much. I would say that also the administrative burden when a farmer goes to get a loan is probably significantly lower comparing to the one that you would get when you go get a grant, which is something that would incentivize the farmer to go for a loan. And it's also relevant to go get a loan since farmers, they have high demand for investments. We need to boost competitiveness in that sector as well. And given that we've seen the success of the previous scheme, we can see that there is interest in this sector to get funding through loans as well. Thank you.
Thank you very much. Well, that does bring us to the end of this part of the conference. I have to go on stage, but yes, you can, yeah. Hello, welcome back and ready for the next round. So I'd just like to give everyone a quick reminder that we will be having questions and Q&A after each of our presentations that we will hear today. And so I'd like to now kick off with the next session of today's events, which is focusing on the results from this Fee Compass survey from 2023 that we've heard a lot about, on the financing needs of EU farmers and agri-food enterprises. And to do so, I would like to welcome to the stage Mario Guido, who is the Financial Instruments Advisor at the European Investment Bank, and Frank Lee, who is Head of Financial Intermediary Advisory Division at the European Investment Bank. So as with the previous sessions, we will hear presentations from each of our speakers and then move to a Q&A session. So, Mario, the floor is yours.
Thank you, Natasha. Thank you, everybody, for being here. I'm very happy to be able to share with you the results of this exercise, which has kept us busy for the last few months. The overall idea is obviously to provide EAFRD managing authorities and all the sector stakeholders with first-hand information on the financial environment for farmers and agri-food enterprises, also with a view to help them with the decision on whether to use or not financial instruments under their CAP strategic plans that were just launched at the beginning of 2023. So the first slide is just to give you very shortly a few methodological elements on this exercise. The analysis is based on a survey on a representative sample of agri-food enterprises and farmers, around 9,000 almost in total. The enterprises were asked about their financial and economic data for 2022. The study covers 24 member states, meaning all the member states apart from the small ones where it's a bit more difficult to collect this type of feedback, also given limited resources that we have, obviously. Based on the result of the survey, we have updated the estimate of the financing gap that we have published in 2020. So we have new numbers for this gap estimate that you see on your left-hand side in the slide on top. So the gap went up substantially from 46 to 62 billion overall, which obviously is in general bad news, but we need also to consider that this is also the result of a number of diverging, let's say, forces which bring us to this result, which need also to be considered. A large part of this gap is in fact the result of an increased demand for finance from the sector, which is expressed by the increased number of farmers looking for finance, going to banks and asking for finance, mainly for investments. Also, the average loan amount has increased, and this brings up the gap. And this is per se not a negative, let's say, news, because it means that farmers are willing to invest, and they are also more open to go more open to the dialogue with the banking sector. What we saw in the previous edition of the survey, there was a bit, banks and farmers seem to be too detached towards somehow. And now it seems they are getting closer, and I think this is, offers big opportunity also for the use of financial instruments. We have some good news in the fact that, in fact, also the approach from the banking side has changed, and they seem to be more favorable in accepting, let's say, loan applications from farmers. As you see, the rejection rate of loan applications went down substantially in this last few years. Other elements to consider for the gap estimate is the number of farms that are refusing a loan offer from the bank because, for example, this may be too expensive, and this might obviously be linked also to the growing interest rates in the market. And the other element is that more farmers are consider applying, but don't do it for fear of rejection, meaning they are not confident enough, not knowledgeable enough. And we normally count this also in the estimate of the gap, because we consider that there are also a market failure. But this also, you can look at this also from the positive side. There are more farmers who are considering concretely going to a bank to borrow and to invest, but they probably are not still confident enough. So maybe they need some help in terms, for example, of technical support to help them, going for this step and go really to the bank and submit formally a loan request. Now, here we have, I would say, some negative news in the sense that obviously this average situation at the EU level, then it's, hides big differences at member state level, and access to credit conditions are very different in the different member states. In the table on your right-hand side, you see the value of the gap estimated at the national level. It went up a bit everywhere, as you see, although there is a decrease in some member states, particularly in Eastern Europe, Central Europe, and Greece went down a bit. Overall has increased, but what is more important, I think today, we don't have time to go into the detail of the member states, but the message is there is still a big divergence in access to credit conditions in the different member states, which obviously is a call for policy action. And this is not shown not only by the value of the gap, but also many other indicators, and in particular the success rate in loan applications, which is very different between the different member states. Other key elements from a policy perspective are the fact that the gap is still concentrated among small farmers. This is obviously because they are more in number, but also because they struggle to get finance, and this is shown by many other indicators. The other important element is that this gap is mainly concentrated in long-term finance, and if you sum up long-term finance and medium-term finance, so financing for investment, there you have a large part of the gap, and obviously it's very important to unlock this potential, let's say, to have the necessary investments for the transition of the sector. And now a short focus on the situation for young farmers. The gap for young farmers has increased as well, from 12 to around 14 billion euro. Now, also there, some positive news, some negative news. Young farmers are applying for finance much more than we saw in the previous edition of the survey, and they're actually applying more than their older peers, which is also, a new element. And they are borrowing more for long-term and medium-term maturities, so it means they have a higher, propensity to invest, which again, it's something positive at the end. In terms of their relation with the banking system, you see that the rejection rate for young farmers is still a little bit higher compared to the older, let's say, generation of farmers. But also there, the rejection rate went down dramatically compared to the previous edition of the survey in 2017, so there is a positive evolution also there. And the last thing that I wanted to highlight is that young farmers are much less likely to refuse a loan offer from the bank compared to older farmers. And this might not necessarily be a good news in the sense that sometimes they may be more in need, to invest in their farm, so they have less, let's say, negotiating power, and they can, it's more difficult to them to refuse the loan offer. Maybe this is my reading, at least, of this data. And then they are also more confident in approaching banks. Their rate of non-application due to fear of rejection is lower compared to older farmers. So, I mean, for me, these slides, gives us, indicates us one important challenge, which is that young farmers still need support to access finance. But there is also an important opportunity, because we see that young farmers really are willing to invest in their farm. They are open to in the dialogue with the banking system. So if we can help them achieving this, then we can get a big push to the investments that we need for the long-term sustainability of the sector, economic and environmental sustainability as well. In this slide, you can see the purpose of the loans applied for in 2022. And we have distinguished between successful application and unsuccessful application. Now, overall, the main objectives of investment in the farming sector are for increasing capacity or efficiency of the operations, followed by working capital. When we look at the other items, however, there is, we notice an important difference between the successful and unsuccessful applications. So, for example, for purchase of loan, even it's really striking that a much higher percentage of loans were for land purchase when the loan were rejected compared to the successful application. And the same thing we see for some of the items related to green investments or investment for climate adaptation as well in the lower part of the graph. Now, I mean, we need to be prudent here, because this graph doesn't give us any, let's say, final, conclusion, obviously, but it's an indication that, financing for some types of investments might be more difficult than in other cases. So more, I would say, straightforward analysis, straightforward investments for competitiveness might be, easier to get financed compared to some environmental, for example, investments which maybe have a very long payback period and so on. So might be this the reason for that. And now a short focus on green investments as well. We have asked the farmers to indicate among these investment items where they have invested in the last 3 years and where they plan to invest in the next 3 years. And you see that, the sector is already, engaged in investing for environmental, climate, resilience purposes. Energy efficiency and renewable energy in particular are very important items, but also climate adaptation, irrigation, and also investment in technology or ecological practices to make farming more sustainable. So this is also, very good news, obviously. We need to consider that this attitude is also the result of the impact that the climate change is already having on the sector. We have some questions in the survey for this as well. And for example, we saw that like 86% of the farms said that they have been impacted by droughts in the last 3 years. 68% by extreme weather events. So, I mean, and we know this, everybody of us knows that, what's happening in terms of climate change and weather related events. And interesting thing is also what we got when we asked about the main obstacles that they see in investing even more in the sector. And clearly, the high cost that sometimes they have to bear for these investments and the long payback period, as well as access to external finance also from bank, is for them an obstacle to invest further in green areas. But also lack of knowledge, information on this type of investments is important. So these are all things that we need to consider, and they are important from a policy perspective, obviously. Finally, based on the replies of the survey, we have tried to estimate what is the share of the gap which refers to these types of investments, so green investments, to use this generic label. And this represents around 30% of the gap that we have estimated, so around, let's say, 19 billion euro. Obviously, this is only the gap which relates to the loan application or potential loan applications for 2022, and it's not obviously the overall amount of money which is needed for the transition of the sector, that we can assume it's, you know, much, much higher, obviously. And now a few things on the agri-food SMEs, so food processing SMEs, basically. The situation looks a bit better, or much better probably. The gap has substantially reduced in the last year, but I mean, as similar to the agriculture sector, this is the result also of different elements that we need to consider. And in fact, an important part of the gap reduction is due to a reduction on the financing demand from the enterprises, which is represented by the lower number of SMEs applying and the decreased average loan amount that we have noticed in the survey. So this obviously drives down the gap, but it's not necessarily a positive news, because it means probably there is a problem with investments in the sector. The attitude for investments may be going down, so it's something to obviously that requires further investigation. The positive news is there as well, that the banking sector is more open also to the agri-food, let's say, sector, and rejection rate is also going down from between 2017 and 2022 also for agri-food. The other drivers of the gap more or less remained stable, I would say, during this period. Now, in terms of, you know, critical elements that we need to consider from a policy point of view, obviously, also in this case, the gap is concentrated among small enterprises, particularly in long-term lending for small enterprises. So this is something obviously to consider for any, you know, policy strategy in the future, but obviously it's not surprising. And the other thing is, again, also here, the divergence in access to credit condition in the different member states. Here you see the value of the estimated gap at member state level. The situation, as you see, I mean, the gap went down a bit everywhere, but still there are differences. And apart from this, you know, number of the gap estimate, many indicators show that you find in the publication. I cannot show today, there is not enough time. Show that, you know, again, access to credit condition are very, very different if you are in one member state or another member state in the EU. And last thing on the agri-food, well, we have asked the agri-food SMEs basically the same questions that we have asked to the farmers in terms of their attitude and their experience related to green investments. And interestingly enough, we got basically the same answers. So also in the agri-food sector, on top of the priorities are energy efficiency and renewable energies. But also there is a substantial number of enterprises that is investing already to increase their environmental and climate sustainability, and also many of them which are already investing in climate adaptation measures. And when we have asked about the obstacles that they see for, you know, going for doing more in terms of green investments, well, also these are the same as the ones reported by farmers. So high cost, long-term payback periods, and also access to finance, but also lack of knowledge and information. And we have done the same estimate of the value of the financing gap for this sector, which would be around 1.3 billion, referring again only to 2022 loan applications or potential applications. So I have only two last slides. Probably I'm speaking too much, I'm sorry. But I'm almost there. Just my recap of what we have seen so far, at least my, you know, personal view on this, is that the banking sector is responding better to the financing needs of the agriculture sector. Despite this, the gap has increased also due to an increase on the demand for finance from the sector, which, as I said, is also an opportunity because it gives us more room to help to support the sector through financial instruments, obviously, and with the support of the private sector, commercial banks, and so on. We have problems with divergence in access to credit conditions between member states, the problem for small farms, and we have noticed that there might be some difficulties in lending for purchase of land as well. But again, this would require some further investigation, but it's probably a problem because, I mean, it's, you know, something which is recognized in the sector, I would say. Young farmers, well, there, as I said, I mean, they have some difficulty still in access finance, but there is also an important opportunity. Empowering them to go for their investments will bring big benefit to the sector. Finally, for climate change, there is a positive attitude in the sector, but also some obstacles. And in our view, given the obstacles which have been signaled, obviously financial instruments providing funding, combined with grants that can reduce the cost of the investment, as well as with technical support to help them for the lack of knowledge and information, can be a key, let's say, game changer, according to us, for you know, to have more sustainability and in the sector. And finally, for the agri-food, well, here there as well, you know, it's going well. More positive approach from the banking sector, but also a reduced demand from the sector, which should be also further analyzed. The gap is concentrated among small enterprises, and there is a big divergence still in access to credit conditions in the different member states, so also something important. And when it comes to green investments, well, the same consideration that I already made for the agri sector, basically. So I think we should join forces and use financial instruments, use the EAFRD together with private finance through financial instruments, and combine this also with technical and advisory support. And with this, yeah, you have all the QR code to download the publication. So please do it, and thank you.
Thank you very much.
So my intervention is focusing a little bit more on the middleman in the process, which is the banks. Obviously, this is, as Mario presented, the main piece of work was the survey of the farmers and the agri-food companies, and it was a follow-up to a survey, as you saw, that we did a couple of years ago. And obviously, you see in general that the gap has widened, at least on the farming side. But this time around, we also thought we would add another dimension to the analysis. One, as I said, focusing on the intermediary, the banks as such, because what we found is that there are a lot of analysis that suggests that gaps are enormous across all sorts of sectors, massive amounts of market failure. But what we often need to also consider is what's then the absorption capacity and the delivery architecture. Is it suitable to actually respond to that gap? And usually it's not. And so a gap can persist, and it usually does. So we thought it would be quite useful on a sort of a very focused intervention level to also talk to the banks in this respect. So what did we do? We actually identified a relatively focused group of intermediaries, 25 in fact, and we actually only looked at a subset of the geography of the EU, as you see on the map, with a strong focus on Southern Europe in particular. And why did we choose that? Well, invariably the gaps, that is where the biggest gaps are, but also it also was to some extent an interest that we had together with DG Agri, because we saw that managing authorities in these particular countries were already considering to some extent using financial instruments. So in a way, we were looking for more evidence to actually equip managing authorities to make that decision on whether or not to go with financial instruments. So the gap analysis of the farmers, the survey, together with this work, we're hoping will actually provide the evidence base that managing authorities need to actually move forward with financial instruments. So we reached out to 25 banks in these 6 countries. We only got 15 back, which actually is not bad. Normally people don't have time to respond to very detailed questionnaires, and in fact we had to follow up with a couple of them, but the 15 responses were quite interesting in terms of what we saw. I'd like to take the opportunity, of course, today to thank again the banks that actually were willing to participate in this work with us. Some of them I think are here today, represented here today. So thanks for the time. We actually organized a seminar with them earlier on in the year where we actually presented the ideas that we had in order to do more financial instrument work in these markets. And we were very much inspired by the model that was presented to you earlier today in the Irish case, because it's a very good example of how we're bringing together public resources, the firepower of the EIB, the mandate management capacity of the EIF, and obviously the advisory services and the technical assistance, as you heard about, the green eligibility checker. What was perhaps missing to some extent in the Irish model was, is there also room for grant combinations within that structure? So we also presented the concept of grant combinations. As you know, the regulations in the current MFF make it easier to combine grants with financial instruments, and we believe that that's actually a bit of a game changer in addressing the market demand. So, I mean, the results are to some extent very consistent with what you've heard about the farmers' survey. This is sort of the good news, and then I'll come to the bad news, as we always do. The good news is that the banking sector seemingly is relatively comfortable with agricultural risk. Now, I must say that this was a survey done in the first half of this year. It was before a number of geopolitical and climatic events which happened over the summer, and I would dare to say that perhaps the results, if we were to do this again now, might be a bit different. Interest rates have continued to remain stubbornly high, in fact increased in many countries. So I would imagine that some of the results that you see here are perhaps a little bit less optimistic nowadays if we were to do the survey again. But you can see that generally there was comfort in the sector. Banks essentially are interested in doing more lending. There's a wide range of the types of loans that are being extended in terms of size, in terms of tenor. In some cases, banks are willing to lend up to 20 years, but on average, it's about 6.5 years. So that was the good news. Of course, we then wanted to know more about why were banks not doing more. And again, no surprises really in terms of the results. They are quite consistent with what the farmers' survey was telling us. Changes in market conditions, rising interest rates already taking an effect, as it seems. In some cases, banks are restricted in terms of the overall volume of lending that they can do to the sector because they are always trying to diversify their portfolios. They don't want to lend too much in any particular sector. So this is to some extent a constraint. And then, of course, the obvious constraints that you also heard about today in the presentations already this morning, the lack of collateral available to the banks obviously restricts their lending, particularly when it comes to financing land purchase. And some other, very specific factors. And we went on then to focus on a couple of very specific topics where we asked for a bit more information. Financing of land acquisition. Generally, there's a strong support for this because generally it's a good base for collateral for banks, of course. But there are some constraints. Although generally the banks saw much more demand for this sort of financing going forward. Again, relatively consistent with what the farmers were telling us, farmers survey was telling us. However, quite big differences across the member states. As you know, the land prices across the various member states varies quite considerably. In some cases, it's obviously easier to finance this sort of stuff than in others. There was one particular feedback from banks, which is that it would be good to look at how parceling or reparceling of land could be done in a more efficient way. Generally, I guess, pushing for more consolidation to some extent in the sector. We then asked a few questions around green. The results, again, very consistent with what the farmers' survey was telling us, that generally there is a willingness and a strong motivation for banks these days to do more green investments, driven primarily by regulatory requirements, etc. And we see that in this particular sector, the banks are seeing demand, particularly in the energy efficiency and renewable energy investments that farmers are doing. And generally, there was very positive feedback that more investment in this particular sector is expected moving forward over the next 3 years. One particularly interesting feedback was, and it also relates to what Mario was saying, that to some extent, banks perceive green investments to be relatively risky because of generally long payback periods, uncertainty around the economic return of some of these investments. So there was this expression of interest in terms of saying, can we get cheaper financing, particularly for green
investments. And you heard again from the colleague from Ireland today telling you that there was an incentive also given to banks who actually were willing to do more lending for green and sustainable investments. And this is something that was generally of interest to banks, giving more incentive. And also to some extent grant combinations starts to play a role here. We asked the banks obviously whether they were interested in more funding. This was obviously particularly interesting from EIB's lending perspective. Surprise, surprise, the banks of course said that they are. Generally there's a scarcity of long-term, low-interest funding in the sector, as again we've heard about today on numerous occasions. So looking for long-term financing, looking for affordable financing, again, no surprises there. Interesting guarantees, absolutely. This will obviously allow banks to do more lending to the sector where they have concentration limits. It will allow them to do lending where there is no collateral or insufficient collateral, and it essentially allows them also to lower their interest rates and the cost of financing because the risk is essentially covered by the guarantees coming from generally the public sector. So again, no big surprises here. We then asked a question about grant combinations, and I have to say that the results were a bit mixed, I think primarily because banks are still somewhat unfamiliar about how to manage grants. Generally, there's a lot of nervousness amongst banks about managing grants. They see this as something that comes with a lot of rules attached and a lot of administrative burden. I mean, generally, as you can appreciate, banks are not used to managing grants. They lend money. They expect to get it back. So to some extent, it's a bit of a culture shock for banks. But we have seen, for example, with national promotional banks, there's much more comfort in managing grants in combination with loans, for example. But this was the feedback from commercial banks in particular, who, as I say, are not typically that used to it. But nevertheless, they see some value in this and are seemingly willing to explore how this would work in practice. And they see, obviously, a strong interest in interest rate subsidies, which is something to some extent they are more familiar with, and also straightforward capital grants, as opposed to other kinds of more sophisticated grant interventions, which are to some extent dependent on certain outcomes and performance. Advisory support, of course, as always, usually welcomed. We asked this specifically in connection with green and climate investment. We asked questions around the use of the green checker. Generally, the banks were very positive about this. In some cases, the banks obviously have very sophisticated systems themselves, so they would not necessarily look to use a new IT system, for example. But generally, there was a lot of positive reception to this. So, I mean, to conclude, essentially, it's the same message as you've heard 3 or 4 times today. Given access to guarantees, given access to long-term funding, banks will do more. And I suppose that's not really a surprise, but it's at least good news, and hopefully good news for managing authorities and other public bodies who are wanting to get the evidence and to make the decisions about whether or not they want to go with financial instruments. And of course, it's good news for us as EIB. We obviously see more demand for long-term funding, which is the business that we're in. We see more demand for guarantees, which is the business that our EIF colleagues are interested in. So generally, a massive opportunity, I suppose, is how we can summarize this best. It is now obviously up to us and you, particularly as managing authorities, to decide whether you want to actually take up the challenge. And as was mentioned to you earlier today, we and the DG Agri colleagues are obviously here to help you in that pathway. And please do come to us if you have any more questions. And that's it. Thank you very much.
Thank you. Thank you very much for that. So I will now we'll now open the Q&A part of this. Actually, I'd like to kick off with a couple of questions myself, and then I will throw it to the audience. So Mario, firstly, I'd be quite curious. You spoke a lot about young farmers. I'm wondering, did you see any differences when it came to access to credit conditions based on gender of the farm manager? Did you see any differences there? Is that working? No, okay. This one?
Is this work? Yeah.
Yes,
okay.
there we go.
Sorry, it's my fault. Well, yeah, this is one, piece of good news that we got from the survey, actually, that there's basically no difference in access to credit between, based on gender. So basically, if women entrepreneurs go to a bank, their probability that their loan application is approved is not different from the one of their male colleagues. It's actually, they perform a little bit better, actually.
Oh. Okay.
But what we notice is that on the other hand, there is female entrepreneurs, they tend to apply a bit less for finance. It's a bit higher the rate of non-application due to fear of rejection. So maybe there is still some lack of confidence in this sense that maybe could also be addressed by public actions as well.
Mm-hmm. And what kind of public action? Do you have any insights into what kind of?
Well, obviously, awareness raising and technical support to help them to be aware on how the banking system works and help also entrepreneurs, all of them, obviously, to get ready and to go to a bank with a good project and then get a successful outcome.
Okay. Thank you. Well, it's positive news from that. Frank, let me just turn to you now. In your market testing exercise, did you also collect feedback about the capacity of banks in tracking green investments? Did you glean any insights into that?
Can you hear me?
Yes,
yeah.
That's working.
We definitely asked the questions. To some extent, we got a bit of a mixed feedback, possibly because people didn't quite understand the question, perhaps. I don't know. I think generally what was confirmed by the survey, and to some extent which we knew, was that banks are at various levels of development in terms of tracking the green investments that they make. And as we know in this sector, what do we mean by climate is a bit of an unknown, as we all know. So to some extent, it's lack of clarity of what is green and what's not green in the first place. But then secondly, banks are at various levels of sophistication and development in terms of their in-house models and rules and procedures that they follow. Obviously, the bigger banks tend to have more advanced systems. In some cases, they have their own checking tools and things. In other cases, not so much. So again, not really a surprise, but at least positive in the sense, as I said, that there's a very strong awareness that they need to do more on green, and that they are actively looking for more green investments to build their portfolios because of regulatory requirements that are coming up down the road.
Right. Okay. Well, I'd now like to throw out to the questions in the audience. Does anybody have a question? Yes, we've got a hand here. If you could just introduce yourself and keep your question nice and concise, that would be great. Thank you.
Good morning. Marion Picot from the European Council of Young Farmers, CIJA. First of all, congratulations to the teams for this amazing survey and overview. We have seen that young farmers have gained confidence when it comes to their relationship with the bank. So the next step would be, how do we increase that confidence? Does it come, for example, with more clarity on the direction? For example, you just mentioned on green investments, what is green? Who is in the driving seat to define that clarity? And second, what is the role of the value chain in all of that? And what is especially that role in terms of giving more economic stability to the farmers in order to have also more security in their investment? Thank you very much.
All right, thank you for your questions. Who would like to come in on this?
Okay, I'm taking it. It's what I think I just said. I think we need to think to a comprehensive package that we offer to the sector, to the entrepreneurs and young farmers in particular, which includes, more funding, also possibly combination with grant support, because with the high interest rates that we have currently, this economic sustainability of investments may be, and the financial sustainability may be difficult. And the other leg that we need to add, obviously, is providing advisory support, technical support on the ground, really to help the entrepreneurs to design the right project. And this includes also, the green transition and the investments related to it. As you have seen, we are also doing something to help both banks and the farmers farmers and the other entrepreneurs to know what are the green investments, and so that there is at least some level of certainty. Obviously, this is just interpretation based on the rules that you are given, and then it's obviously not for us to define the rules.
Frank, I saw you nodding there. Do you have a comment to add?
Well, I mean, it's a multifaceted question, and I guess we could spend a whole day discussing the various components of it. But I guess, as Mario said, I mean, it was very positive, the feedback, in the sense that as you were saying, young farmers seem more entrepreneurial, seem more willing to take the risk, I suppose, as you would expect, to make more investment, to get into the business. And the constraints from the bank's point of view are, as you saw from the survey, were usually linked to land purchase and the provision of long-term finance. On the provision of long-term finance, you will actually hear from my colleague later on that at least on the EIB side, we actually are now considering financing the purchase of land when it comes to young farmers. It's something that, as a policy bank, we have not supported for a number of reasons. But when it comes to young farmers, we see definitely a market failure and something that we need to support. And we are aligning ourselves, of course, with the EAFRD regulations, which of course also allow the purchase of land when using financial instruments. So this is a very strong incentive to managing authorities to use financial instruments, particularly to support young farmers, for example, in the purchase of land. We also know that in many countries, managing authorities have special grant programs that are linked to young farmers. We would encourage those grant programs to be somehow combined with the financial instrument and with the lending, for example, that's coming from the banks in a more smart way, if I might say that. So I think there are a number of possibilities which we all as stakeholders have to respond to.
Okay, I hope that answered your questions. We have any other questions? Probably have time for one more before lunch, yes? If you could just introduce yourself and...
Casper Zulum de Zwarte from OP2B. I'm actually rather interested in the second half of Marion's question. What do you consider is the role of the supply chain in this?
The role of the supply chain?
Yeah, so I forgot this. It's my fault. Well, obviously the supply chain is, it's a key element, a key driver of the investment and the green transition of the sector, and because obviously the farmers do what is required then, downstream in their where they sell their products. So this is really a key element. We are planning some analysis on this to really understand a bit better, given these financing needs and the relation with the banks, what can be then the role of the, for example, the processing industries or the retailers and so on, to help also connecting the farmers with the financial sector as well. So yeah, we are. I mean, I cannot give you an answer. What is the role? I don't know. But what I can tell you that we also think this is important, and we are going to analyze also this thing. Maybe at the next event we can focus really on this topic.
So do you have a timeline?
I would love to be part of that discussion.
Okay. Do you have a timeline for the study, or you?
Well, I mean, no,
okay.
We're not commit now to a timeline, but we are starting. This I can say. Yeah.
Okay. Frank, did you want to come in on this point?
No, I was just wondering. I was looking at our DG Agri colleagues whether they wanted to add anything on this, but.
Do your colleagues from DG Agri, would you like to add anything? Yes, thank you.
Yeah, Michael Pielke, DG Agriculture. Yeah, of course, the whole value chain is key to organize the transition. But of course, our influence is somewhat limited. Yeah, so what we try to promote with our policy is transition both in primary production, agriculture, but also in processing and marketing.
This next session will be focusing on policy considerations on the use of financial instruments under the CAP. And to talk about this, I would like to welcome to the stage Michael Pielke, who is the Director at the European Commission's DG Agri for Sustainability and Head of the Economic Sustainability Unit. So Michael, the floor is yours for your presentation.
So, ladies and gentlemen, good afternoon. I'm very pleased to see you all again on this 19th annual conference. All this community interested in financial instruments for farming and rural areas. So my task today is, first of all, to highlight some developments in the farming sector and to complement it with the findings of the FI-Compass study. Secondly, to inform you about the progress of the financial instruments which we have established under the CAP strategic plans and the rural development plans. And last but not least, to explain why for us the partnership with the European Investment Bank and the EIF is so important. Yeah, we heard today the huge financial gap in the farming sector, 38 billion increasing to 62 billion euro. But it's not only the financial gaps, I think it's also the development of the farming sectors, and my reflections are based on the development which you find when you look at the Eurostat statistics. So first of all, we have to see a huge decline of farming over the last 10 years, so 25% decline in farming. And the losses in particular prominent in the category below 5 hectares, but also in the group 5 to 20 hectares of farming. And but if you look the size beyond 20 hectares, you find quite a stable situation. So I think in this group we see that farmers manage to organize generational renewal and also to have a kind of viable business concept, I think, which is key. So consequently, the average size of farms, according to Eurostat, increased from 13 to 17 hectares. But the structural change is not equal in all farming sectors, and you see that whereas the farms specialized in field crops, they are quite stable. The majority of farms who stop operating are those in livestock sector. So in particular when it comes to pig and poultry production, but also in cattle, sheep, and goats. And I think here, we can also see that in particular those sectors which are, first of all, labor and capital intensive, they are definitely facing huge challenges. Last but not least, Eurostat also shows what was already mentioned this morning, the need to accelerate the generational renewal. I think the average farm manager age of 57 years, we cannot be happy with this figure. We have to accelerate the generational renewal. And that's also one thing which we are very much dedicated to. But on the other hand, I think on a more positive note, we have to see that although we have this huge structural change in farming, there is no major land abandonment on average to be seen. And when it comes to organic farming, which was already mentioned this morning by participants, in the end, if you look over the long-term period, over the last 10 years, you see that there we have really a huge increase. So we have a doubling of the land farmed under organic from 6 million to 30 million hectare. But at the same time, I think here we have to see that it's not only the area which is important when we talk about organic. In order to have a stable organic farming development, we need to look at really the whole supply chain. And I think it's not only about financing conversion to organic, it's also organizing market outlets, it's about organizing processing and retail to really have a kind of stable and sustainable organic farming. When it comes to the size of farms in terms of economic size, no surprise that the farms which are larger, more than 250,000 euros standard output, they have increased, while of course the lowest group with 8,000 euros decreased. So we have here clear indication of the structural change. But I think we have to see this a little bit more differentiated, because it doesn't mean that there is no room for smaller farms. I think in the end it depends on the specific situation, on the business concept. Does the small farm find a kind of a niche market, or do they work with income combination? I think we have to be less we need to be more differentiated and have a closer look on this potential of small farms and find the specific ways to support them, because from a policy point of view, they fulfill an important function in rural areas, and they can also be very important for addressing our sustainability goals. When it comes on agriculture training, we support an increase of farms who have a more higher agriculture training, so the full agriculture training. So there you find an increase by 3%, which is good news. And I think sustainable farming is complex. I think farming manages a complex biological system, and with all the societal expectations farming has to meet. I think we need well-trained farmers, well-trained in environmental terms, but also in production terms, but also in economic terms. And I think here we also have to refer what we have heard today, that knowledge transfer, knowledge about how financial markets operate, how do I get access to finance. These are skills modern farmers need to have. Yeah, as regards social structure, we see that the number of female farmers is not increasing, rather declining. And also, as I said, the category of farmers below 42 years is low, and it has even shrinked. So I think here we see a clear mandate to improve the situation, and I think there also we have to come up with new ideas also in terms of how we can promote financial instruments to help those farmers. I don't want to repeat what has been said this morning about the challenges farmers face, about the impact of the COVID-19 crisis, the Russian aggression in Ukraine. I think this picture is well illustrated. It's more the question now what we can do about it, and I think one element could be more to have a more targeted and a more efficient use of public funding. But before going into that, we also looked a little bit from a Eurostat perspective on what is the situation in farming when it comes to capital, to loans. And there, I think one thing is not a surprise that you have loans. The loans are linked to more larger farms, but overall, I think we have to see that in the farming sectors, the farms with short-term loans, the percentage increased from 23% to 32%. And when it comes to long-term loans, we are quite stable with around 22% of farms who have long-term loans, and I think this is clear. This is also reflects the need for farmers to invest. When it comes to how they finance, okay, it's clear commercial loans are the majority of the way farmers get access to capital. 78% of all liabilities in recent years. Family private financing only plays a lower role with 3%. Last not least, when we look at the different sectors of farming, we have to see that according to our data, the majority of loans goes to field crops, dairy farms, and followed by livestock farms, both in long-term finance and short-term finance. But here maybe we have to look a little bit more in detail in the question, what are the specific needs of different sectors when it comes to access to capital. Until now, we haven't looked into this question very in depth. Yeah, as I already said, if you look at the repetition of loans to the different sizes, economic sizes of farms, you see that the majority of loans is with farms between 100,000 and 500,000 euros. This farm size is not the main size of farms. If you look back at the farm structure, but these groups of farms are those who are very active in terms of seeking capital from banks. Yeah. Overall, the FADN data shows that the long-term value of long-term loans over the time has increased from average 37,000 euros to 54,000 euros, so a steady increase. Yeah, what does it mean to us, all these statistics and figures? And I think one thing is important to say, that the market forces play their role. Structural change continues. And I think we have to face it, and we have to see that if we want to have a diversified structure of agricultural holdings, we have to come with solutions tailor-made to the different types of farming. Secondly, I think it shows that in particular farms, smaller farms and mid-sized farms, there we have to work on their economic viability. And there also finance can play a role, but not only finance, also efficient and viable business models. Then secondly, green investment, green transition will not be possible without investments. And here I think the limited amount of grants we have available need to be complemented by financial instruments. We have to increase the firepower of our public funds if we really want to face all these different challenges. And we also see when the farm sector is very diversified. We have certain groups where we have to have a closer look and have to pay more attention, like young farmers and female farmers, of course. And I believe that in this context, financial instruments can play a role, can complement grants, because as I said, the amount of money for grants is limited, and we have to increase the firepower of our policy. So where are we with the financial instruments under the rural development policy? We have 32 of them, and already 66% of the EAFRD available funding of the old period have been declared. And in some member states and regions such as Croatia, Estonia, Poland, and some Italian regions, budgets are already almost exhausted. We talk about 94, 99%. But also others catching up, Romania, France, Portugal, and Latvia, they also half or more than 2/3 of the budget is gone. Overall, we will achieve a total amount of loans and guarantees about 1 billion euro. And this is achieved with around 300 million FRD. And I think that's a nice relation. 300 million public funds, a budget for investment of 1 billion. And I think this shows the potential of financial instruments. And I think that's what we need to work on. Now let's talk about the future, the next programming period, which has just started. We are now in the middle of the first year of implementation, which all its challenges and difficulties, but also I think we see that the policy is starting to be implemented. And under the new policy, we will have 12 member states who implement financial instruments. And now we will have 1 billion euro, not alone, but we will have 1 billion euro public funds spent on financial instruments, of which EAFRD will count for around 627 million. So what are the member states are named there. So we have Slovakia, Portugal, Spain, Greece, France, Latvia, Lithuania, Bulgaria, Poland, Italy, Estonia, and Croatia. So a good mixture, east, south, north member states. And I think we will all learn from their experience, and of course we hope all that they will be good examples for others to come. If you look at the overall budget of these financial instruments, first of all, we will have more than 800 million total public support for investments. So still the focus of financial instruments is very much on investments, also including young farmers, of course. And we have 88 million euro total public support, which is specifically planned for installation of young farmers. So this is in particular Spain, Greece, France, Latvia, Lithuania, and Bulgaria, who have this additional focus, I think, which is good news for young farmers, and it's also good news for all of us, because we need this generational renewal for the known reasons. Of course, we believe that more could be done. I think we could put more money in financial instruments, because we see that those programs are overall successful and the resources are absorbed. But also we think that some member states could have the potential to install new financial instruments. Yeah, let me come to our partner, the EIB. So since we had the Memorandum of Understanding, we have had many initiatives, studies, and activities, and also the very successful Young Farmers Initiative under Commissioner Hogan with the 1 billion euro, which was very successful and very quickly absorbed. And I think the EIB for us, it's not only a partner which provides us with expertise and knowledge, but I think it's also a partner where we expect that they will continue to strengthen the role of agriculture in their portfolio to make it visible, because we believe agriculture is a strategic sector, so it should be also visible in our policies. Of course, the important role they play in financing the CAP strategic plans. Yeah, and of course, the very successful work of Compass with our studies, which I believe has proved to be very helpful to provide factual evidence of the possibilities and the potential of financial instruments. And there, I'm very grateful for all the works colleagues have done. What comes next? One point definitely, the colleague has mentioned them, the agri-food chain. So we will have a closer look on there, what we can do with financial instruments, also in processing and marketing, and to have a closer look on what the whole food supply chain can do. And secondly, of course, green investments. I think we all see the need, what was also mentioned this morning, the need to continue with the Green Deal, but we need to continue in a way that we create more win-win situations, that with our support, farming is economically viable and at the same time delivers on our sustainability goals. So with this, I would wish us a good, fruitful discussion, and we will continue. We are dedicated to continue to promote financial instruments as a complement to grants, and with the objective to increase economic viability and sustainability of farming. Thank you.
I'd like to welcome to the stage now Berta Brun-Leon, who is the Director of the Financial Institutions Department at the European Investment Bank, and Alessandro Gargani, who I definitely didn't say his name correctly, apologies, Gargani, potentially, Senior Business Development and Mandate Manager at the European Investment Fund. And so, Berta, the floor is yours. Thank you.
Yes, good afternoon, ladies and gentlemen. We've heard this morning and just now about the needs of the agriculture sector, and in particular the farmers and young farmers. You've also seen a national scheme targeted to support the sector, specifically from Ireland, supported by the EIB Group. Now, together with my colleague Alessandro from the EIF, I would like to give you now a broader overview of what the EIB Group offers to the sector and what our further plans are. The EIB Group consists of the European Investment Bank and the European Investment Fund. We offer complementary funding, guarantees and equity products that we offer to the public sector and the private sector. Together, last year, we had an activity volume of around 74 billion, of which 9 billion by the EIF. And on the EIB side, around 90% is traditionally done in the EU, while the remaining part supports EU policy objectives outside the EU. Now, EIB develops its activity in 4 priority areas, essentially, which contribute roughly similar amounts. You see a slight overweight in the climate and energy-related objectives, which has been a recent emphasis after adoption of our Climate Bank roadmap. Now, the 4 pillars are, the first one I would like to call projects for around the brain and the body. So projects from the brain, meaning research, development and innovation, new technologies. Projects for the brain, so basically investment in education, skills enhancements. And around the body we have projects in the healthcare sector and life sciences. Now, the second group of, the second pillar of our key priorities is around all projects that support the net zero economy objectives and in general the sustainability of our resources. Now, transport ways, say the third one is essentially around brick and mortar projects that connect our cities and regions and ensure a balanced and sustainable development through investments in both rural and urban areas. And here we have, for instance, sustainable transport projects a lot. The last priority area is about caring about the 99%. So the 99% of small companies in the EU that form the backbone of the EU economy due to the large share of employment that it aggregates, value added, and that have the most challenging access to finance, as we have heard. Cutting across these 4 priority objectives, we have 2 transversal ones. One is around climate action and environmental sustainability. Our objective is that about half of our projects and financings each year contributes to these transversal objectives as well. And we also have cohesion, which is at the heart and origin of the EU project. Now, projects in support of the agricultural, bioeconomy and rural sectors, they can contribute to all of these objectives. Innovation is key for the bioeconomy sector, and you may have, actually we saw an example in the video of new technologies, how they can support precision farm management. It can be investment in the electrification or in general new modern agricultural equipment, in modernized production processes, innovations in food production, and in general also agricultural education. This was mentioned in by one of the speakers before. Under the second, for instance, we have renewable energy projects, so installation of solar panels. We have biomass or biogas for energy production. We have biomaterials, for instance, packaging industry, and energy efficiency projects, all concerning, very relevant for the agriculture sector. Irrigation projects, rural forest or port infrastructure could fall under the third objective, and the fourth one falls square and flat into the agriculture sector because, as we have heard, the sector is made up of small companies, farmers, mid-caps, cooperatives. All of these are key target beneficiaries for us because they're small, they have difficulties in access to finance, and we have been given a good illustration of the market gaps this morning and just now by Michael as well. So more concretely, how do we support the agriculture sector? On the first hand, we have direct financing to the private sector. We have by now in operation the third generation of program loan, under which we offer investment loans to essentially mid-cap, small and mid-cap companies for research, development, innovation, and modernization, industrial scale-up projects, so of the sort that you see here in the first pillar. Then we also co-finance the public sector for waterways, irrigation projects, the rehabilitation and modernization of such infrastructure. And in general, we co-finance regional development programs in the form of framework loans. Now, these regional development programs can have investments all sorts of projects, not only agricultural ones, but innovation, regional territorial development, etc. And the last one, in order to reach out to the large universe of small companies, we partner with banks under our intermediated finance product palette. We set up we have thematic financings for the agricultural sector under a program loan that was launched in 2019, and we have an envelope also already earmarked going forward. That already also includes a focus on young farmers. We also have examples of targeted financial instruments. There's one example in Andalusia where indeed we provide higher risk capacity to the implementing bank to reach out to the agricultural sector. Now, EIB cannot reach out to the 23-ish million of SMEs in the EU directly. We sit in Luxembourg and we simply do not have that network and the direct client relationships nor the resource capacity for that. So the model that we apply is that of intermediation through financial institutions, bank or non-bank, which are indeed close to the SMEs. They know the local environment, they have the client relationship and the history, and they have local knowledge and expertise. So typical intermediary institutions are commercial banks, are national promotional or regional promotional banks. There are leasing companies, cooperative banks, very relevant for the sector, and also specialized lenders. So by providing funding or guarantees to these intermediaries, we can trigger a benefit that is transferred to the final beneficiaries that can come in the form of a lower interest rate, longer maturities, maybe less collateral requirement, in general, better access to finance. So maybe a counterpart that would not have gotten a loan could then get a loan, potentially, or similar advantages. Now, more concretely, in terms of the advantages that come with financing of the EIB, is we have a AAA rating that allows us to finance ourselves very advantageously in the capital markets, and this funding benefit we can transfer to a large part via the intermediary banks to the final beneficiaries. Depending on the economic life of the assets that we finance under one or the other project, we can offer long maturities, sometimes very long in the case of infrastructure projects. And in general, our financing comes with good flexibility in terms of the use, so the drawdown of the funds, the repayment of the funds that we seek to adapt to the financing needs and possibilities of repayment. Also the currency, we do not only finance in euro, but also non-euro currencies. So in general, our financing tends to diversify the funding base of intermediaries and make it more stable. Also, our balance sheet capacity allows us to extend guarantees, so to offer risk-taking capacity, share risks in loans that the banks extend to mid-caps or small companies. And as we are taking more risks, the capital relief benefit that is generated is also translated into new lending to beneficiaries. I will refer later to a very nice example, in my view, of a securitization which we did with a regional bank in Spain that has generated a very high impact on rural SMEs. We are also generally seen in the market as generating a signaling effect, a positive signaling also to private co-financiers, because we usually do not finance 100% of the projects or even the SME lines. We always require that the bank finances €1 for €1 that we finance. And the last benefit, I would say, is the technical assistance and advisory offer that we have through our advisory colleagues sitting here in the front line, and in particular also to promote green lending in the sector. Now, as we the support now more concretely in terms of what we have done already in the sector, in 2019 we launched a dedicated program loan for 700 million that also included a specific focus on young farmers. We complemented this with parallel lines, so in total we had 1 billion that we extended to the sector, and which is expected to mobilize nearly 3 billion of financing in the economy. And during COVID, where indeed beneficiaries had a much more difficult life, we introduced measures of flexibility to continue the good outreach. Now, as we do not finance banks for their own purpose, well, unless they have a specific project that we could finance, which is rare, we finance through the banks and with the banks. So for us, it is important that the money arrives in at the level of the final beneficiaries and in the real economy. This so-called on-lending process usually takes 2 to 3 years. That is a normal time frame that the bank needs to originate new loans to their clients. Now, when we look at the past 3.5 years, we have actually reached out to 22,000 beneficiaries in the agriculture sector, so 22,000 loans in the last 3.5 years alone. What is interesting when we look at the profile of these allocations, that we call them, is that the average tenor has been 6.5 years, which is, as average tenor, is really long term. So that means that our lines do indeed promote medium and long-term lending in the sector. Also, I've noticed that loans, the average loan size to small companies, so those with up to 50 employees, and to medium-sized companies, so up to 250 employees, so SMEs, those average loan sizes were higher than our general average that we have in our SME and mid-cap portfolio that is not sector-specific. So that also, I think, fits very well with the loan requirements that were set out previously by other speakers. Here you see 5 concrete examples. It's not all of them that we have, but it's 5 of them that we have done recently, which are still in the market operating. The first one, for instance, so far has reached out to nearly 2,000 beneficiaries. And the last one is the one actually that I wanted to highlight with Cajamar. It is a bank with a regional strong foothold in the Andalusia and Murcia regions in southern Spain. And here we actually mobilized a volume of nearly 3 times the amount of that we have signed, and 5,600 beneficiaries so far. So how could we achieve this high impact with this operation? That lies in the product. Here we have guaranteed tranches in a securitization issued by Cajamar together with the EIF, and this fact generates a higher multiplier, meaning we are taking higher risks in this operation, and this higher risk taking allows us to require that the intermediary reaches out and originates more loans to the economy. And as a rural cooperative bank, Cajamar is really able to reach out to the sector. Now, even in our general SME and mid-cap lines, which are not labeled sector-specific, I have to say that we generally have a good outreach also to agri-food companies, especially with intermediaries that have a cooperative origin and may have become large banking groups by now. They continue to have a captive clientele in the sector, so we do reach out also under our general themed lines to the sector. Actually, a very recent example from this week is we invested in a covered bond issued by Crédit Agricole Italia, and this was the first covered bond under the new covered bond framework, and that is expected to reach out to Italian SMEs, mid-caps, and the agri-food sector. Now, I've presented to you now what we have done so far. Now, what do we plan to do going forward? As the sector is really of vital importance, not only for specific regions, but generally for food security and the sustainability of our resources, we will continue with the thematic focus for sure, and offer our targeted intermediated lending. We will also support regional partners, in particular with specific advisory, financing and advisory and technical assistance, which the green checker was mentioned before. So we offer this generally, and it is very, very appreciated. And we have now also introduced specific new eligibilities, particularly to open up to the financing needs of young farmers, notably in regard of land acquisition. So we have new eligibilities around the transmission of land, so generational change, about conservation and rehabilitation of land resources for their sustainable and productive use. Now, we have identified and reserved an envelope of up to 1 billion lines also in our pipeline of operations for the next 12 months. In fact, 2 specific dedicated operations are already approved and are on track to be signed in the next weeks. So I cannot yet make them public, but we are on track with very concrete operations there. And lastly, we will continue to actively offer our advisory services to, in particular, respond to the need of sector companies for climate-related investments. So climate adaptation, adaptation to the climate change, protection against flood and droughts, or investments in climate mitigation, so energy efficiency, renewable energy, etc. Thank you very much. I pass now on to Alessandro, who will complement with the EIF product offer.
So thank you. I will go on in presenting more in detail what the EIF does in the context of the EIB Group. The general presentation of the EIF was made by Birte. How do I? Okay. So basically, in the let's say in the framework of what the EIB does in terms of offering finance throughout Europe, we are specialized on SMEs. So we believe in small, as we say. We target only access to finance for SMEs, and we are focused in structuring financial products that can leverage the investors' money. So our basic job is to raise money from mandators. We don't raise money on the capital markets like the EIB does. We get mandates either by the EIB and the Commission or by member states and regional authorities. And we try to leverage those money with structured finance operations in order to reach SMEs. Just to give you a figure, each euro invested through our mandates, we aim to mobilize at least 5 euros of additional finance for SMEs. So that's what we do. And in the last couple of years, quite some years by now, we have decided to focus on agriculture. Now, focus on agriculture would mean different things. The first one has been to look at what kind of support we would give to agriculture in the context of our standard activity. We offer guarantees, we offer equity products, we offer debt finance channeled through banks, through financial intermediaries. And what we used to do already happened to cover agriculture, but we decided to study that, to look into it, and to open up a line of business that would be focused on agriculture. What we mean by focused, we mean setting up financial instruments that would be targeting specifically the agri-sector, the agribusiness, and at the same time also trying to, what we say, build an ecosystem, so incentivize financial intermediaries to propose operations for our standard products, but by their decision, focused on agriculture. So these are the numbers we now constantly monitor, are significant in terms of our reaching the sector. I will not go through all the figures, but basically we are in the area of the billions, and we have by now supported more than 350,000 final recipient transactions with farmers or with agribusiness. This is the overall picture of what we do in the sector, both with our products not specifically targeting agri, but we have now, as I said, a dedicated line with mandates that are negotiated only for agri. Most of it has been developed in cooperation with DG Agri. It's been an amazing interinstitutional and operational cooperation in reaching out managing authorities and supporting them in setting up financial instruments. So we now have a significant presence throughout Europe with financial instruments only targeting agri. Now, in the language of the rural development programs, this would be investments in agriculture, but I will say something more about it. So it would be the good old measures 4.1 and 4.2 of the rural development programs. This is what we do and what we cover with the EAFRD. But setting up this line also brought us to discuss with some member states, namely 2, Ireland and France, dedicated financial instrument that ended up being supported also by national budget. So these are the numbers and the presence in Europe of financial instruments offered to banks, specifically guarantees with very few exceptions, offered to financial intermediaries only for supporting farmers and the agribusiness. And we are continuing this with the new CAP. So the summary is that we have all these mandates. In green, we have the EAFRD mandates. And as you can see, the leveraged amount to SMEs is reaching and surpassing 1 billion by now. Now, there is an overlap with the data presented by Michael Pilke before, because of course he captured the whole picture, including also financial instruments not managed by the EIF, but this can give you an idea of how significant our effort in this space has been with the EAFRD managing authorities and also with some national states. And also this table can give you an idea of how this money is leveraged, because this is one of the key features of this financial instrument. With much less money than it would be used to support farmers via grants or via simple funded products, with structured finance, we can support loans for volumes much more significant than that. So this is our overall picture. Now, what kind of products do we deliver? In general, the EIF provides guarantees and funds to equity, so venture capital and in general private equity. In the agricultural space, the dedicated instruments have been only in debt. We have one experiment in Romania with a funded product, so a co-financing loan, but just quickly to present, our guarantee is a portfolio guarantee, so it's not a guarantee that we issue loan by loan, transaction by transaction. We sign with a bank, and we offer the bank a guarantee, a portfolio guarantee, on a portfolio that the bank commits to originate on our behalf. And on this portfolio, we cover risk. Now, when there is a capped guarantee, the risk we cover is covered on a transaction by transaction basis, loan by loan, we say, at a certain percentage, typically 80%. So when there are defaults, we cover 80% of the defaulted amount, but there is a cap rate at portfolio level, around 25% in general, also for regulatory purposes. So basically, for a 100 million portfolio, the bank knows that each default would be covered by the EIF at an 80% rate. But then when the losses would reach 25 million, then the cap would be reached, then we would stop covering losses beyond that. This is a very effective instrument because it has the highest possible leverage. Now, in all our products, and this is the case, we impose to the bank to reduce the interest rate on the farmer, reducing by 80% the credit risk margin on the client. So if the component of the interest rate linked to risk would be 3%, it would end up being only 0.6 because we cover that risk, and therefore, with our AAA guarantee, the bank cannot charge the risk fee on that client for the part which is covered by our guarantee. So this is our capped guarantee. We are more and more offering this product jointly with an interest rate subsidy, but maybe I will cover it in my conclusions because this is one of the key points given the market situation at the moment. Then we offer a product that has more complexity. It usually comes with a price because there are other investors. So we offer uncapped guarantees. Uncapped is again a guarantee that would cover 80% losses on each loan in the portfolio. But in this case, we don't set any cap at portfolio level. Now, of course, this is the best possible situation for a bank because the loan is covered no matter what on the portfolio. But at the same time, the actual risk is diversified because, of course, it's very impossible that on a portfolio of 100 million, the bank will lose 80. So what happens with this product, we combine resources. They oftentimes are from the EIB when eligible and subject to the conditions set by the EIB. In this case, we offer a guarantee to the bank, which is 80%, but the money coming from the public investors, the money coming from the managing authority of EAFRD would still be around 25%. It can be more in this case because it needs to give the protection to the senior investor. But this is a product that has a slightly lower leverage because there's more coverage, but is very important not only because the risk coverage is more, but for a technical reason linked to capital relief for banks. Because when we give an uncapped guarantee, basically the bank can write off its capital allocation, regulatory capital allocation to the portfolio, thanks to our guarantee, because our guarantee is indeed uncapped. Now, the last product I wanted to present is instead a product that was somehow outdated. It was considered to be history, but in an environment with rising interest rate, it may be considered again in the coming future. It's a co-financing facility whereby we don't give a guarantee to the bank, but the bank receives an endowment of money to be used loan by loan as source of funding as well, but also with the risk component. So for the same 100 million portfolio used as an example, the bank would disburse only 50 million. The other 50 million would come from the managing authority investing in the financial instrument. And in that situation, if the loan would default, still the bank would not lose the 50 million or the quota, the 50% on the loan, because the loss would be on our co-financing, and then, of course, there would be recovery. This is important because in this case, the interest rate reduction would not be linked to the credit risk fee, like in the case of the guarantees, but here the reduction in the interest rate is a write-off of 50% of the interest rate. So in the example before, whatever the cost of funding plus the credit risk margin of the client is reduced by half, and then 50% discount on the interest rate. These are the three products we offer for financial instrument. As I said, basically two, the guarantees, but with an interesting example on an old-fashioned instrument. Now, we've done quite some of these in the last 5 to 7 years, and we have some lesson learned that we like to share, and FICOMPASS is one of the best places to do that. The first lesson to be learned is that one of the really key aspects to be looked at is the general offer of public support on the same segment. If we talk young farmers, if we talk agri or agribusiness in general. Now, it's very intuitive that grants can be an alternative to financial instrument. That's, of course, that's obvious, but there's more to it. Because what we have seen is that the more public support to finance there is on the market, other guarantees, other financing facilities, even not specifically targeting agri, is a key factor, because the financial instruments have to be designed in order to fill a market gap, but taking into consideration also how that market gap can be addressed by other means that we would not expect. One example, when we want to offer a guarantee for agri, if there are other guarantees that cover agri but are more relaxed in terms of eligibility, banks will have more difficulties in accepting our guarantee with strings attached when they know they can still cover the demand in the sector. So when we want to leverage this push effect, we have to thoroughly assess the public support. The engagement of financial instruments. Whatever we do works if works for banks. So we isolated some specific issues which are very relevant for banks when implementing financial instrument for agri. I would start from the last. Combination with grants is an issue. Combination with grants is not only the crowding out or the substitution effect, but is only the possibilities that are leveraged in some countries of covering with a guarantee the famous own means by the farmer when he receives a grant. This is possible, and in some countries this has been, let's say, a turning point in absorption, because when the bank can get a guarantee on the loan that gives on an investment that already receives a grant, maybe there is, let's say, less leverage overall for the money of the program, fair enough, but the financial instrument becomes more interesting, but the complication to that in terms of checking the maximum aid and dealing with the requirements of the combination are heavy. State aid, or in general, calculation of the aid, the gross grant equivalent calculation is key, and in general also the definition of the sector. I mean, we have done a lot. Normal business practice is to look at the NACE code, to look at the code where the company operates. Now, eligibility and especially aid implications under EAFRD are linked to the CN code, Annex 1 of the treaty. So there's a lot to be learned by the banks in order to address these issues. So this is another important issue. And then specific eligibility, because we have learned that irrigation investments under the CAP policy are something that for banks is difficult to digest and to deal with. And on the good sides instead, and was mentioned at different times today, working capital and purchase of land is where financial instruments are getting closer to the market, and working capital can really be a new game in the new programming period. And then just to close on the new game in the new programming period, very quickly a recap on how our cooperation works with member states. We engage with managing authorities to get the first investment for the riskiest part of the financial instrument. Together with the managing authority, we identify the gaps. We look at the best instruments suited for that market and for that situation. We design the financial instrument. We find additional resources, mainly by liaising with the EIB. And then we do what we call a market test. We engage with the market to see what the potential demand for that financial instrument is. Now, in terms of contractual framework, this has, in this programming period, two alternatives. One would be a bilateral agreement between the managing authority and the EIF, and the alternative would be a contribution to InvestEU, which is an option offered by the Commission to the Member State, very technical, to be discussed in case of any interest. I wouldn't say anything else. So this is the part of the contractual structure to set up a financial instrument with a Member State. And then we launch a call to the market, a call for expression of interest, and we select the banks, and then we sign operational agreements, typically guarantee agreements, with the banks where the banks commit to originate new portfolio of loans at the conditions we set out in terms of interest discount and eligibility. Few remarks on the new generation. What is dear to me to say is that the EIF really aims at being on the edge of the novelties. We don't want and we don't like to be overlapping what a member state can easily and happily doing alone. What we would like to do is to experiment what's next. Now, what's next in our view in this programming period is, given the market condition, the combination of any financial instrument with interest subsidy. We are seeing more and more that without an interest subsidy, financial instruments are becoming weaker and weaker, either in terms of support, interest reduction technically is lower relatively, and also in the psychology and optics linked to a financial instrument. Focus on climate action and digital transformation, environmental sustainability. So we are doing less and less general purpose financial instruments. We are in the climate roadmap set by the EIB. So of course we are experimenting on how to offer, even to specific sectors like agri, dedicated instruments for climate action and environmental sustainability. And then just to close the loop on the lesson learned, support to banks. The idea that we can offer a very good guarantee to a bank and that's it, we sign the contract and we live happily forever, doesn't fly, doesn't work. EIB advisory has been key on that in developing tools. We have introduced the tool, which is in the form of a document, the use case document, for example, for the sustainability guarantee. In some countries, Portugal, for example, we set up with the managing authority an eligibility check toolkit for the banks on how to tick all the boxes. This activity is key for the success. Without this activity, we really believe that this movement we want in the market, with the key role of the financial intermediaries to be engaged, can fall short, and that's where we will try to focus. Thank you.
One question here. Please do try and keep your questions very short and to the point, if you can.
I'll try to keep it very short. Thank you.
Okay.
Casper Zulum de Zwarte from the...
There we go.
Casper Zulum de Zwarte from World Business Council for Sustainable Development. What I noticed is that I like the instruments a lot, but it always starts with public funding being committed to the instrument. Is there a possibility to make that blended funding? Because there are a lot of large industries also investing in farmers, and they're looking for something to co-finance.
Okay. Who would like to jump in on this one? Alessandro?
Yes, thank you. That's a very good question. Indeed, what we do overall at the EIF on the market is try to leverage a lot other investors. In all transparency, the financial instrument where we so far managed to attract private investors are mainly in the equity space and are in the securitization spaces, which is a space where we didn't dare so far to adventure for agri. These kind of public guarantees with the need component linked to it and with the main part being the riskiest part, basically the coverage of expected loss technically, are, let's say, weaker in terms of attracting other investors, namely private investors. But yeah, we would definitely look with the highest interest to any chance to do that, but it didn't happen. The only experience we tried to do, just to go a little bit further, in Italy we set up an uncapped guarantee where the idea was to attract investors, at least institutional investors in the country, but it didn't fly. We didn't find any. And then it didn't succeed on the market, but that's another story. More linked to the banks and not to the investors.
Okay. Did you want to comment on this point? Yeah.
I can only say where...
Yes, I think it's good.
Okay.
Yes.
Not generally, in financial instruments that we structure, they are by nature blended instruments. So combining European structural funds, for instance, or other European funds with EIB or EIB Group resources and private sector resources. Now, in our direct financing or direct guarantees, as I said before, we never finance or guarantee 100% of the needs and of the project cost. We normally ask that at least the same amount is risk shared or financed by the intermediary. So by nature, also there, our participation is intended to have a catalyzing effect on the participation of other co-financiers.
Okay, thank you. Any other questions from the audience? I think I saw a yes, hand over there. If we could get the microphone. Yes. Thank you.
Thank you very much. Arkadiusz Lejski, Polish Bank Association. Is there any possibility to introduce such rules that partners, I mean commercial banks, for example, cooperative banks, could offer only working capital in the system, not only complemented with investments? Because especially in the countries, for example, affected by the war, in Ukraine, we need working capital for farmers, for our economy, not only with investments. Is it possible, or it will be possible, maybe? Thank you.
Yeah.
Yeah, thank you for this question. In the end, it depends on the construction of the financial instruments under the given CAP strategic plan of the member state. We have some member states who have explicitly working capital as a possibility for financial instruments under their CAP strategic plan, and that's of course possible.
Okay.
I can also confirm that for EIB financing and guarantees, both working capital and investments are eligible. Now, during COVID times, for instance, where indeed the needs shifted more from the investment need to short-term working capital needs, we flexibilized our existing interventions to allow for a high share of working capital during that phase, for instance. Now, we do try to respond to the evolving market needs in that respect, but generally both of them are eligible.
And we have one question in the middle as well here. Yes.
Bonjour. Alors moi j'ai une question, enfin une double question.
So I have two questions, actually. I would like to know if the EIB has already identified perhaps intermediaries with whom it works with for outermost regions. As we know, the outermost regions have a particular status. The second question, you talked about combining funds and creating synergies. Could the EIB finance projects that are financed in the first instance by horizontal European programs beyond the structural funds? We talked a lot about the EIF, but is there a possibility of synergies, of combining financing and funding with the EIB? Thank you.
Who would like to jump in first? The first, yes? Okay.
I can take the first. Yes, basically the selection process for the banks we engage with, the selection process for the banks we engage with is a public one. So all the banks that currently have our financial instrument are publicized on our website, but they are all selected as a result of a call for expression of interest we launch. So basically, the list of banks we work with is public, but they are selected based on their application and their submission of interest. We don't, of course, we communicate our products, but we don't reach out ourselves to the banks. We publish call for expression of interest, and then we evaluate the application we receive, and then we enter in contracts with the banks that result assessed by our services and selected. So the list is public, is on the web.
Okay, and perhaps the second part of the question? Anyone? Or anything to add on either question?
I'm not sure whether I understood the question correctly. The combination with horizontal programs, so you meaning structural funds?
Life, yes, life, best life, Horizon Europe, for example.
We've had examples in the past, indeed, where we set up blended financial instruments that in part used funds from the Horizon 2020 program as a mezzanine protection. So the first loss came from structural funds of certain member states or regions. Second loss came from these horizontal programs. And then this was complemented by EIB Group resources, and all of this to combine this increased volume of resources to that was during a time where a counter-cyclical intervention was needed to support SMEs and mid-caps.
Okay, I think unfortunately there's no more time to elaborate on that, but perhaps you can speak further on the coffee break. But I'll bring this Q&A session to a close. Thank you very much to all of our speakers. I'd like to invite you to take a seat. Thank you very much. I would like to invite Agnes Kazlowski, who is a policy officer at DG Regio, to the stage for your presentation. Agnes, the floor is yours.
Thank you very much. So hello, dear colleagues, dear guests, and I hope quite a lot of financial instrument fans in the audience still left. My name is Agne, as I was introduced, and I am from working in a financial instruments unit in DG Regio. And I'm here to share with you some very good news that we have for the current programming period, which I'm sure most of you already know, which is exactly the combinations, the possibility to combine financial instruments with grants. And can I just ask about my presentation to basically where is this? Sorry. To
move the slide.
Is it this one?
Yes.
Yeah. Okay.
Oh, yeah, you have it.
Voila. So before I jump to the subject itself, I would like to start with some numbers. And I'm actually very happy to start with numbers and not with a definition of financial instrument or not defining the benefits of financial instruments. As you can see, that financial instruments as such are already widely acknowledged across the EU member states, and we are very happy about it. So here I wanted to show you some numbers on the progress of the implementation of financial instruments under cohesion policy in 2014 and 20. And I can say that numbers speak for themselves, and we have, by the end of 2022, we have already more than 16 billion euros that reached the market and that reached our final recipients. So as compared to the previous year, it grew. It is a significant increase. So we can say that overall, the uptake of financial instruments is getting it's getting bigger and faster as compared to previous programming periods. And this gives us also hope that we don't need to convince member states anymore. Even we still do in some sectors, but overall that now we are in a position to help member states as much as possible to actually encourage them to do more, as it was also encouraged by my previous colleagues. So moving on to this current programming period, I also wanted to show you some overall slides on where we are now with financial instruments under cohesion policy. So you also see quite a lot of numbers, but here I would say that the key message is that we are very happy to see that member states they are already moving from the classical sectors, which has clearly a potential for financial instruments such as SME support, energy efficiency, and we already see member states that will be piloting financial instruments in other sectors, renewable energy, circular economy, research and development, urban development, and others. So this is also a very good tendency. That is happening under cohesion policy in this programming period. And in the next slide, here it's just a short slide to a breakdown by countries for those two sectors that remains the key investment sectors for financial instruments under cohesion policy, which is SME support and energy efficiency. But here, maybe I wanted just to note that we see also that there is a lot of difference in member states, since we have some member states that will be investing in these sectors almost 100%. Via financial instruments, and also we have some countries that we have some even zeros here, but this does not mean that they stopped implementing financial instruments, because we know some cases where financial instruments will be done from the reflows, which means that there is a continuity already thanks to EU cohesion funds. But now I want to move to the key topic of this presentation, which is exactly this novelty that was presented by the new Common Provisions Regulation in 2021 and 27, which is a possibility for managing authorities to combine grant with financial instrument in one operation. It is important to note that this is not some kind of a theoretical opportunity. This novelty, this legal novelty, is here because we saw already quite a lot of good practices in member states that were trying to do these combinations already in 2014 and 20 using their national funds or combining those two forms of support in two different operations, which was not easy if some of you already tried. So actually this CPR novelty is here because it actually can really help to deliver EU policy objectives and also to help address market failures that are specifically related to the project design, because as we know there is a lot of problems that there is just a lack of technical capacities to do good projects. Also very much this grant element could also solve or partly solve the viability gaps of the projects, or of course just help to make those projects more attractive for commercial investors. So primarily the goal of this novelty is actually, well, the combinations as such are needed in the areas where the investments are not capable to generate sufficient cost saving or to generate some returns that makes those projects viable for a financial instrument. So this is actually, we see this grant element not as a tool to help to build a better financial instrument and to actually reach some scale in different areas. And besides that, also combinations largely can help with many other objectives of a managing authority, depending on what they like and what they need, such as just to stimulate the investment demand as such, because you can use a grant to incentivize your project promoters. Also, if you have some very specific policy objectives that you need to reach, you can also use a grant as an encouragement for the market to uptake to reach better results. And as I mentioned before, of course, it could also help a lot in attracting private financing. So here is a slide, there is a slide of the provision, concrete provision itself in the Common Provision Regulation, which is Article 58. And I just wanted to summarize what it is. So basically, according to this article, managing authorities have two options to combine. So the first one is the old-fashioned one, where you can do the combination in two different operations, which means that you have different rules, grant rules that apply for the grant, and then financial instrument rules that apply for the financial instrument, which is also from my own practice, previous practice, is a really hard thing to do. So the second option for managing authorities is actually this opportunity to combine it in one operation. And honestly, this is really this is really a simplification and a novelty that was very welcomed by all our managing authorities under cohesion funds, since this helps to build a much more flexible instrument, and both for managing authorities, for the middle-level managers of financial instruments, as well as for the final beneficiaries. Speaking of what's new in this legal framework, of course, we have a novelty, or how to say, we suggest new types of grants. So the typology of grants that could be combined is widened. So as you may have heard, that we had already a lot of practices in combining financial instruments with interest rate subsidies, with guarantee fee subsidies, or technical support already back in 2014 and 20. However, now this possibility is wider. You can also have a combination of capital rebates or capital grants to cover the, for example, the investment part, which is not viable or not very attractive for commercial banks. Also, you can have a grant which is performance-based, which helps a lot, as I mentioned earlier, to link this investment and this instrument with the concrete policy objectives. Key principles that has to be taken into account when you do the combination is actually nothing new. Most of them were there already in 14 and 20 periods. So basically, it is important to check that the sum of all forms of support it is not bigger than the expenditure item overall. Also, grants cannot be used to pay back the loans or pay back any support from the financial instruments, and financial instruments also cannot be used to pre-finance grants. So this is something that we knew already from a previous programming period. The final point is that it's also important that we do have a separate accounting for those two forms of support. Moving on a little bit deeper into the subject, what is this one operation? What do we mean by suggesting this combination in one operation? So first of all, managing authorities, they have to justify, first of all, for themselves, and then, of course, for the European Commission, that this grant is directly linked and necessary to the financial instrument. What does it mean in practice? So basically, this grant element should help to build a better financial instrument, either in scale, in terms of volume, or in terms of better results under certain policy objective. And this is very important because, as I said, this combinations is not just a blending of a grant and financial instrument. It has a purpose, and we need, and usually we see this justification already in the programs. Another important point or rule, what needs to be checked when you do the combination in one operation, is that this program support in the form of grant, it is not bigger, it's not larger than the investment supported by the financial product. An important point here is that we need to check this not at the project by project cases. But at the portfolio level, which actually gives more flexibility for member states, for managing authorities, to do more streamlined the financial instruments, because, for example, at a project-by-project level, you could have projects getting 90% of grant or even more. But at the portfolio level, we have to keep this balance between investments and grants. Another 2 points, which is of course very important, is that we try to ensure that these financial instruments, combined ones, becomes a one-stop shop or one window for final beneficiaries as well. So meaning that a final beneficiary, they don't have to fill 2 different applications to get a loan and to get a grant. Everything is done is provided from one hand, which is a body implementing financial instrument. We have to have all the provisions related to grant in one funding agreement with a fund manager. And as I said, then there is an agreement between holding fund manager and if there is any banks also involved, how the grant funds will be managed. And final but very important one is that when you have a grant element combined with a financial instrument, for the grant element we also apply financial instrument rules. Which is, I think, a great flexibility, as you may know, because if we do the grants and we meet the auditors, you know that they check invoices, and it's not only that. So having this grant element inside the fund gives an opportunity to actually deploy these funds to market faster. Okay, now since sorry. Yeah, I need to, yes, okay. So maybe I'll just, I think this is, the couple 2 slides more are very important because, as I said, the combinations are already very much welcomed by the managing authorities under cohesion funds. So here I extracted some of very frequently asked questions from the managing authorities related to this topic. So I will just quickly go through them to, maybe they will be helpful for you as well. So first one that we usually get is how and where to show that those grants are actually necessary and that is linked. So as you know, that first check we do at the program level. So in program, we already see where the member states are going. And we have some justifications on the form of support. Further managing authorities can use ex-ante assessments or any other documents where they can provide the arguments why this grant is necessary for the financial instrument. The second question we get is about the grant component itself and how we calculate it or how it is implemented. So again, it's very important to know that the key document where all the methodology related to grant calculation is the funding agreement. So whatever managing authority puts there will be followed by the participants in the instrument, as well as auditors, of course. So there it is very important to have as concrete as possible provisions that it's clear for everyone how the grant will be managed. And as mentioned before, we have the grant itself will be provided by the body implementing financial instrument. Then third question that we have this like a fear. Some fears, is it true or not? I'm not sure, but some banks we talked with, they are reluctant in general to manage any grants because usually it's not a bank's business to manage grant. However, we saw some good cases where national promotional banks, if they are the managers, could also be helpful in this case. This could be a division between the body implementing financial instruments and specific funds, how to divide these activities related to grant. 3 more, 2 more questions that I wanted to also share with you, which is very important one related to management expenses of the management of grant. Also what is new, or not new, but if you have this combined instrument, so body managing financial instrument will be getting a management fee for management of the grant. So this is, I think, very important and could also work as an encouragement for the banks themselves to actually work with these grants. So the total management costs and fees are calculated on the total amount. So not only investment amount, but also grant amount. Then another question is, of course, related to audits and how auditors will look at this hybrid instrument. And here also there is a good news that if we combine those two forms of support, the audit approach to such kind of instruments will be followed according to the financial instrument rules, which means that auditors will not go to the final beneficiaries and will not check the invoices for the grant part. I think this is very interesting. And also in terms of irregularities, well, I mean, maybe I will not quote what I have in the slide, but you will have the slides, but basically depends on the level. If there is any irregularity, if it's, you have to check, is it on the loan side or on the grant side? So if it's on the grant side, of course, the grant needs to be recovered from the final beneficiary. If it's on the loan side, loan is irregular, so cannot be reimbursed, but you don't need to pay back the grant. So it's also a variation. Here we just put, well, share, yeah. Okay, so I mean, you will have this. There's plenty of examples of combinations already. So just the last slide I wanted to show is here we summarized a lot of links to a lot of very useful resources that has been developed for this topic with our dear colleagues from EIB. We have very practical knowledge hubs and notes on this specific topic with a lot of questions that are answered already from the practical side, so I really encourage everyone to check it. Also, we have a very nice podcast with our colleagues discussing the topic and answering the practical aspects of this combinations topic. So I really also, as well, the case studies are there to check in more detail. So I would really encourage you all to check these links, and of course, if you have any, if you want to try, and if you have, or maybe you're already trying, so it will be very interesting to hear you, what are the ideas, and of course, we're ready to help you do this.
Thank you very much.
Thank you.
Thank you. Hello, everyone. Welcome back. We're now nearly at one of our last session, well, the last session, actually, of today's event. And this is about current and new EAFRD financial instruments in member states. So remember at the beginning, I was saying we would be going between Croatia, Ireland, Spain, and have all of these different examples. Well, now is the moment. And so for this, I would like to welcome to the stage Janusz Danaldis, who is Head of Financial Instruments and Risk Management Tools Unit at the Greek Rural Development and Food Industry. We also have Marko Boljat, who is Head of Department for Financial Instruments at the Ministry of Agriculture in Croatia. We have José Ángel Cuevas Santos, who is Head of Service, Centralised Management and Financial Instrument in Spain, Spain's Agricultural Ministry. And Julio Pombo Romero, who is a senior researcher at the University of Madrid on a financial instrument for solar irrigation. So welcome to the stage. Sorry, I will... Yes, you can sit there. Swap. Thank you. So we're going to hear from each of our speakers in turn. So first up, we'll hear from Janusz about your experience from Greece.
Thank you. Hello, everyone. First of all, I would like to thank you for this opportunity for us to present our experience with the deployment of a microfinance instrument under the Greek Rural Development Programme. Our involvement with financial instruments started a few years ago with the ex-ante assessment, and at that time, the ex-ante assessment identified a huge gap, which was quantified at almost €1 billion only for microfinance. And as you can see, the primary sector was responsible for an impressive 99% of this financial instrument. But even though Greek farmers applied for loans only for microfinance, they still have limited access to finance. And possible reasons for that could be the lack of collateral, the lack of credit history, and their inability to cope with the banking procedures. On the other hand, the banking sector considers agriculture as a field with high risk and volatility. So before I proceed with the details of the microloan instrument, I would like to share with you the general picture of financial instruments under the Greek RDP. As you can see, we have a capped guarantee, a first loss portfolio guarantee instrument with EIF acting as the fund manager, and we have the risk-sharing macro-loan instrument with the Hellenic Development Bank acting as the fund manager. In the first case, until the end of June, we had 581 loans signed with a total volume of almost 38 million euros. And these funds mobilized additional investments, so the total investments reached 73 million euros. On the other hand, the microloan under the microloan instrument, there were around 700 contracts signed until the end of June, with a total volume of 16.1 million euros. And under this facility, these loans did not mobilize additional funds. So for both instruments, the total funds mobilized reached almost 90 million euros up to now. Now, the initial budget of the risk-sharing microloan instrument is 21.5 million euros, and the loans provided under the facility range from 3,000 to 25,000 euros, with a maximum duration of 5 years and an optional grace period of 2 years. Half of each loan is provided by the Greek Rural Development Programme, and it's with 0 interest rate, while for the other half of the loans supplied by the banks, we provide a 2-year interest rate subsidy. And in addition, there is an option for technical support. A very important feature of this facility is that no physical collateral is required by the banks, but only debt securities. Ex-ante identified HDB as an adequate fund manager, and the managing authority decided to accept this suggestion. So we performed a due diligence procedure, and we entrusted implementation tasks through a direct award to HDB. HDB is an organization with 20 years of experience in financial instruments, and their main mission is to facilitate access to finance for SMEs. In addition, as a standard procedure for both financial instruments, we identified as final recipients of this instrument the potential beneficiaries of grant under measure 4.1 and 4.2 of Greek RDP. And we did that in order to allow for all beneficiaries to combine their grant with financial instruments if they want to. So, the instrument was available at mid-February, and the first contracts with final recipients were signed by the end of March. From that point, the market responded very positively to this financial instrument, and by the end of August, the approved applications for loans reached the number of 1,500 and the volume of 35 million euros. As a result, the whole budget of the instrument was committed to new loans in less than 6 months. Right now, the instrument is inactive, we do not have any more funds to provide, and we are trying to allocate additional funds from the Greek RDP to the financial instrument. We have already allocated 10 more million euros to the instrument, but considering the high demand of the instrument, we believe that this amount of money will extend the lifespan of the instrument only for a month or two. The average loan amount is a little bit more than 23,000 euros, and the available funds are mainly going to be used for investments. 83% of the funds is going to be used for investments, and the remaining 17% of the funds is going to be used for working capital. Now, a very interesting finding is that all final recipients of this particular instrument do not combine the instrument with grants. Possible reasons for that could be that we do not have a recent call for grants during that period, and on the other hand, it seems that the total volume of the loan seems to be not enough to trigger additional investments. Of course, I have to say that ex-ante assessment, according to our ex-ante assessment, farmers need mainly microfinance in order to perform small-scale investments and not higher in bigger-scale investments. Now, from the first graph, we can see that almost all final recipients of this instrument belong to the primary sector, and only a small fraction of them, 1%, belongs to agri-food processors. I have to point out that this graph fully confirms the findings of the ex-ante assessment concerning the allocation of the microfinance gap between the primary sector and the agri-food processors. At the second graph, we can see, for example, that around 42% of the final recipients have a total turnover of around 40,000 euros, while almost 68% of our final recipients have a total turnover of 70,000 euros. And finally, from the third graph, we can see that almost 90% of our final recipients do not have employees at all, or they have only one employee, while 94% of the final recipients, they have a total number of employees up to 2, maximum number of 2 employees. I think that these graphs demonstrate that the instrument addresses the needs of the agricultural holdings, especially the micro-enterprises, which are the most vulnerable part of the agri-food sector. So, assessing the overall performance of the instrument, we can say that one of the main advantages of this is that there is no physical collateral required by the banks, but only debt securities. In addition, as a result, the disbursement of the loans can be very fast because the procedure is very simple now, and the step for the evaluation of the physical collateral is skipped. For example, we have loans that were dispersed to final recipients within 1 month or 2. Now, in addition, the interest rate realized by the final recipient is very, very small. It has a maximum value of 2%, which is a small fraction of the interest rate of the Greek market. In a few words, we have low requirements and very attractive terms. Therefore, we have an attractive product with high approval rate of the applications. On the other hand, we understand that the loan is not used as part of a bigger investment. There is no mobilization of additional funds, but only the amount of the loan is used as investment. In addition, it seems that up to now, the loan is not enough to be used in combination with grants. But in my opinion, as long as we manage to support a sector that is linked to high risk and volatility, I believe that we can accept these disadvantages and live with them. Very briefly, I would like to say that some key takeaways. Ex-ante assessment can be a very powerful tool when designing financial instruments. The final recipients of the primary sector need to realize a substantial benefit from the instrument. Otherwise, they will not be able to distinguish the financial instrument with the commercial loans. This microfinance facility seems to be something that was missing from the Greek market. And finally, another key element is that an important success factor is to establish a good partnership with all involved stakeholders. Now, after assessing the overall performance of the financial instruments under our RDP and considering that our targeted final recipients perceive these mechanisms as a very useful tool for support beyond the use of grants, we decided to continue using them under the CAP strategic plan. In addition to the existing financial instruments, we intend to implement a new instrument for the first time. This is an instrument related to young farmers. And of course, the final form and the details of these products are going to be reflected in the upcoming update of our ex-ante assessment. So, this is the current state of play for microfinance in agri-food sector in Greece. And I would like to thank you very much for your attention.
Thank you very much, Janusz. And next up we have Marko. The floor is yours.
Good afternoon, everybody. Thank you for the opportunity to present the Croatian FIs from two programming periods. So, from the beginning, last programming period, 2014-2020, it was first programming period of Croatia as we become full member state. And we opted not to go with financial instruments from the very beginning. Intention was to start with deploying grants and later on throughout the programming period to think about FIs in context of needs in Croatia. So while setting up, we of course came up to many different doubts or worries of different kind and sought out for help as we find it needed. First of all, I must thank the experts from the FI Compass team because we asked and received targeted coaching that really put us online with financial instruments and all the benefits they can provide. And then later on, throughout the setup phase, we even contacted the colleagues from Estonia as they had up and running very successful financial instruments, and they provided with technical details that are very well received from outside, and I think they helped us. So the financial instruments from that programming period are set by to conduct them through two beneficiaries, two bodies that implement it, through loans and guarantees. Measures are defined by the ex-ante for agri-food, diversification and forestry. And I must say that the initial allocation has been raised several times, and after 5 years of implementation of financial products, it has been disbursed in full. The start of the financial instruments themselves have been followed by a strong media campaign and many workshops throughout the territory of Republic of Croatia. So as I mentioned before, the initial allocation was something around 70 million euros of both EU and national counterpart. and had to be raised, as you see, above 85% raised. So it means in 5 years we almost doubled our allocation. One of the greatest instruments set up, at least from the final beneficiary point of view, are small and micro loans. Hereby I would like to thank the FI Compass for producing the study and publishing it last year, I think, because we really find it useful, and the farmers themselves were eager to be financed by that product. Regarding the FIs and their possibility to adapt to the needs, we have used that opportunity in several occasions. For example, when the COVID pandemics broke out, there are several negative effects on the farmers, and we used the opportunity to put up 2 new financial products, both for standalone working capital, to try to balance that negative effects of the pandemics on the market itself. As I said, we disbursed the FIs that are up and running, and we are now in the phase of second cycle. We are waiting for and using the reflows. As we see it, we can use it in 2 different ways. One of them is to be used as new financing for the same products, and we did that with micro and small loans, given the fact that the high interest for those 2 products. And the other opportunity is to set up new instrument, new product as a national scheme, which we did. We recently published the call for new national working capital loans that deal with problems that arise from the war in Ukraine. So lessons learned, we try to put as many info as it can fit in one slide, but if we want to keep it short, the message would be quite clear: customize the products not for MA's sake, do it for the beneficiary. Surround yourself with good, trustworthy partners, as we did with 2 national teams, Hamag Bikro, Agency for Financing SMEs, and HBOR, National Development Bank. And as they progress through the applications of the farmers, as they evaluate the quality and viability of those applications, you can be assured that you will have reflows later on throughout the years. And have in mind that this is not a short-term game. You don't have to expect the results in a few months, but in a broader way. And if you find that some of the products, some of the elements that you have set up are not functioning really great, you can customize again and adapt to the realistic needs on the field. Regarding the new programming period, 23-27, we have allocated around 17.5 million euros of allocation for the FIs through 3 interventions, and we hope for substantial part of reflows that are planned to be used as a additional national financing under the CAP strategic plan. And we even changed the plan to start in 2026 to next year because of the high demand. So maybe as a conclusion, we can say that from our side, we find financial instrument good tool. Maybe cannot solve all problems, but a lot of them can be addressed in the right manner. And we find it to be still a useful tool, and we plan to continue the implementation. Thank you.
Thank you very much, Marko. I'll pass the floor now to José. José will speak in Spanish, so if you need interpretation, you can do that by your headsets.
Buenas tardes.
Good afternoon. Thank you very much. I wanted to start by apologizing for speaking Spanish, but I'm sure that with the help of the interpretation services, kindly says the speaker, I'll be able to describe the general lines of the Spanish centralized management financial instrument that we've had from 2014 to 2020 and from 2023 till 2027. And so I wanted to insist on the general lines of the instruments over time. All of this has been influenced by the fact that Spain is a decentralized state, so most competencies fall under the autonomous communities, so the Spanish regions. This has led to an instrument that is voluntary for the regions. It is specific for all regions that want to participate in the instrument. It is a guarantee instrument. It includes different management structures that are shared amongst the regions at the end of the day. There is a common link between the different entities, between the banks, the financing authorities that guarantee the best conditions for the loans. If we look at the resources, these are provided by the regions. We have a decentralized structure, so all of the resources fall under different categories. Most euros given by one region will be assigned to the right fields. We have different funds that are combined without having a fund of funds or a portfolio fund. There's no mediation of a fund of funds or holding funds. I'd also like to look into the general lines of the products that we've been able to put into practice over the previous period from 2014 to 2020, which will be valid till 2025, and the ones that are now in the horizon for 2023 and the next period. In January next year, we'll have all of these funds available. From 2014 to 2020, we had a capped portfolio with guarantee instruments with a maximum credit. It was available to all regions that were participating in the instruments. As I said, it was voluntary. And the implementing agency was the Ministry of Agriculture of the Spanish states, which is the authority that I represent, together with SAECA, a public entity that specializes in guarantees that are given to the agri-food and fisheries sector. It specializes in this sector. From 2023 to 2027, we're planning to have the same capped portfolio. We've been satisfied with the results, so we want to give it continuity. But if we apply European regulations, the Ministry of Agriculture now has a new obligation. So in the 2027 horizon, we are the authority in charge of the CAP and its application. So we have one more responsibility. We'll have the same powers that we had, but additional ones as well. We'll continue to collaborate with the SAECA, which is the implementing agency. They'll continue with the same powers, same elements to implement. We've been satisfied with our collaboration, and other entities agreed in keeping them as part of the instrument. It is also a fund of specific funds in this case. And as a supplement of these portfolio instruments, we decided to also include a counter guarantee instrument. This allows us to refinance certain elements. We had a series of projects that we could not fit into the previous guarantee. And so as part of this instrument, we would like to select an implementing agency, but we've already at the last phase of the selection. I'd also like to look into the following, the governance of this instrument, which is quite peculiar, quite specific, because it includes the collaboration between 4 different agencies or authorities. We have the National Management Authority, the Implementing Agency, the Regional Management Authorities, and financial institutions. Each one of them plays different roles. As regards the National Management Authorities, they're in charge of monitoring and control. They monitor and control contributions portfolios, and then they support all of the other agencies. The regional management authorities are focused on answering 3 different questions. How much? That is to say, these authorities need to decide how many financial resources will be granted as support means for the financial instrument. We can have the support from the EAFRD as well as private funds or own funds. What for? That's another quick key question, because the Regional Management Authority will look into what the necessary actions and what the necessary conditions will be. We have seen that different regional authorities can decide, and they can opt for different applications for the same instrument. Regional management authorities also decide for whom this instrument would be aimed at. So they decide who the final recipients are. As regards the implementing agency, they're in charge of formalizing the guarantees, the portfolio instruments, and counter guarantees. They have a fiduciary accounts management, so that the accounting aspects of the instrument are very clear. They carry out selections as regards the financial institutions for selections of grants, and they have the support of the Spanish ministry. And over the next term, we've also foreseen interests as part of a single operation. So as part of these guarantees, we would have supplementary interests. They would be executing any securities or collateral, look into any losses that the instrument has had to face, and lastly, they would also participate in the follow-up or and control of the financial instrument. And then we have the financial institutions that are the ones that provide the loans, the guaranteed loans with the conditions established in the agreements. As part of this presentation, I would also like to describe the different instruments that have been foreseen for 2023-2027. We have the counter-guarantee financial instruments, or the portfolio guarantee financial instrument that has 80% loan-to-loan and a guarantee cap rate of 20% with a 6.25 multiplier. We have portfolios. These are good mechanisms, and they're established per region and per financial institution, per bank. We decided to do so because we wanted to respect the contributions that are given per region and per bank, because we want to avoid two financing institutions, two banks sharing the same loan. Of course, this can be combined with grants in one or two operations, with capital grants and interest rate subsidies. And something specific in this case is that guarantees are not transferred to financial institutions. The amount is retained in each one of them. Of course, this brings about a lot more management, but it gives us a clear picture of the current situation of the instrument to this day. And then we have a second instrument, which is the counter-guarantee financial instrument. If portfolios are based on loans that are homogeneous, we wouldn't face any problems. But in this case, if the portfolio includes very high loans, banks were not prone to grant these loans. There was a very high risk with very high, incredibly high interest rates, and they would need to cover the risk. This has led us to change the situation from 2014 to 2020, especially in the agri-food sector. And in 2023 and 27, we wanted to address this, especially now that we have new operations that need to have sufficient guarantees, high-value operations. This instrument will have sufficient guarantees. Loans are 100% guarantees by an institution. In this case, it would be SAECA as an agro-security company, an insurance or guarantee institution. They would have a counter guarantee. And so they would be acting with that security, with that collateral. The counter guarantee would be for 80% of the loan. And they would have a very, due to the low default rates, SAECA has decided to offer a 6.25 multiplier. So it wouldn't be 0.8 or 0.2. This instrument aims to focus on specific operations. As I said, they're high-value operations. We have that cap or that minimum level of 600,000 euros, even though we're thinking of operations that are a lot higher, with a low amortization period of up to 35 years. as regards the specific examples or the projects that we aim for, it would be irrigation infrastructures for irrigation communities. These are legal entities that are public as well as private and that are key to the agro sector in Spain. We also wanted to aim for photovoltaic systems for irrigation. We have the example of SolaQua. I believe that the next speaker will also mention SolaQua, Julio Pombo, which is a very interesting example. And then we have the agri-food industries that weren't covered in other cases. They were excluded precisely because they were high-value operations. And then lastly, I would like to underscore the general situation of successes and perspectives of the previous period and then the coming period. In the previous period, we were able to have 3 regions out of 17, Castilla y León, Extremadura, and Galicia were the regions between 2014-2020. And then we were able to move on to 10 other regions: Aragón, Baleares, Canarias, Cantabria, Castilla-La Mancha, and Valencia. In 2014, in the previous period, we had 16 financial entities. Obviously, we understand that these financial institutions, these banks, are limited to their coverage, their geographical coverage. With these new regions, we'll be able to cover those territories as well. And just to give you more numbers, on the previous period, we had more than 900 final recipients that obtained a guaranteed loan. More than 1,000 loans have been granted. 163 million in formalized loans. Towards the next period, the program funds, as part of the CAP for centralized management, we hope to multiply this by 125%, by twofold, more than twofold, from 50-something to 128 as a starting number. We know that more autonomous communities will progressively join, and as I said, the mechanism is shared. Some authorities are giving smaller quantities just to try and to start by experimenting with the instrument, but as part of the CAP, we'll hope to increase the coverage and the funds allocated. Thank you very much. That's all from my side.
Thank you very much. And now, last but certainly not least, Julio.
Thank you very much and congratulations for getting this far in the conference. So if you give me another 10 minutes of your time, I will introduce you. SolaQua is the name of the financial instrument. This is a first lesson learned to pick a catchy name for your financial instruments rather than multilateral loan for whatever. It helps a little bit to give it a little bit more popular. So this, as José Ángel, please. Okay, thank you. As José Ángel previously mentioned, this is a financial instrument which is part of a bigger financial instrument, but it's focused in a very, very specific type of projects, which are nevertheless really important in terms of Mediterranean agriculture. Just some figures of the more than 10 million hectares of irrigated land in Europe, regions like Spain, It's more than half the agricultural output depends on irrigated agriculture. It's huge. It's by far the most important water consumption use in our countries. And it's also a very, very heavy energy consumer, and obviously also a very important source of CO2 emissions. For example, in Spain, more or less of a quarter of the energy consumed in agriculture is due to irrigation. It's more or less 2% of the electricity in Spain is consumed only by the irrigation communities. In some crops, 40% of the cost of the crops is due to the energy needed to pump the water from different places to the crops. And it's obviously, and another important issue is that in order to reduce water consumption, which is a very, very important issue in our countries, you need even more energy, because systems that are used to reduce the water consumption require more energy because they work with higher pressures. So energy is key for the decarbonization of, a decarbonized solution for irrigation is key for the decarbonization of the agriculture of the Mediterranean farmers. Okay. So these are just some figures, just to give you an idea. Well, this says, all in all, there's more or less 20 billions will be needed. Please, I know that the slide was missing. Okay, so the solution for decarbonizing the agriculture is solar irrigation, which essentially means to use renewable energy, and in particular solar energy, to pump the water. But it's not as easy as just simply connecting a photovoltaic generator to an irrigation infrastructure. You have also to adapt a lot of things on the infrastructure. You have to change the irrigation patterns. There's many more things related. For example, this installation here, this system here is one of the systems that we built. This is the largest photovoltaic irrigation system in the world right now. It's in Aragon, and it involves an investment of around 2 million euros. So farmers, obviously, we know that, well, this kind of investments are not that easy to be afforded by the farmers, because this is not a public infrastructure. There's farmers have to pay for this system. And as we saw, the most important barrier to decarbonize the agriculture is essentially having to face, to afford the investment needed. In this case, it's very, very clear. So complexities related to the decarbonization of irrigation exceed the capacities of typical farmer exploitation, even of the typical cooperative. They are more close to industrial renewable energy plants, and they need the same kind of solutions in designing, in operating, and also in finance this kind of installations. They are also very, very complex to manage in terms of connecting to the electricity grid. Well, there's a lot of complexities surrounding these systems that exceed the capacity of the normal enterprise of the sector. And it's also very important, the category, the asset category is huge, the amount of money which is required to decarbonize irrigation in Europe. We estimate this is around 20 billion euros we needed if we want to fully decarbonize irrigation, which is possible, which is a good thing. But a lot of money will be needed, and well, here are some figures related to the potential of solar irrigation in Europe, and also related with what that will mean in order to meet the overall renewable energy targets of the countries involved. That's, as you can see, is also very, very, very significant because of the importance of the energy consumption in irrigation. So as we can see, it's a financial instrument which is addressing a very specific type of investments, but that very specific type of investments has a really important, they are really important for the overall sector. So it's not such a bad idea just to design a financial instrument specifically for these projects. Okay, so the key aspect here is that, as in many other sectors, power purchase agreements are needed to secure in particular, the finance for these projects. And in the case of irrigation, project purchase agreements requires that a developer sets up an investment vehicle, a special purpose vehicle, and it raises the funds, debt and equity, to install the system, and a contract is established between this developer and the irrigators just to provide the energy and even the water. And in that case, farmers don't have to afford the upfront cost, so this first barrier is overcome. The farmers don't have to put the upfront money for the systems. Then irrigators over a period of time pay a bill to the developer in order to obtain the energy, or the energy and the water, depending on how the PPA is organized. Obviously, this price is not related to the cost of the energy in the market, which is very important for the farmers, which over the last years, they have had a lot of volatility in their energy prices, and that's something that they are not well equipped to deal with. So this is another important advantage of these systems. And finally, at the end of the period, because of these systems are built on their land, on the land of the farmers, the property of the systems is transferred to the irrigator, or maybe that a rollover of the PPA at different prices can be secured too. So that's the business model which we select to these financial instruments. That's another important issue. This financial instrument is only designed for this business model. There's a relation between the business model and the financial instrument. And for a number of reasons, I'll explain some, but even with this business model that relieves the farmers from the upfront investment, there's a number of problems. First of all, if that this business model has a very high, capital consumption is very high. So the cost of capital is key for offering energy at competitive prices to the farmers. For example, a 1% increase in the cost of capital, it means that the price of the energy for the farmers has to be increased around 10%. So if, as we can see, over the last years, we have 3-4 points more of cost of capital, then the cost of the energy for the farmers is like 30-40% higher than before, and that can make this solution, decarbonized solutions, less competitive in respect to the fossil fuel solutions that are there. So if we cannot address this problem, well, we'll have a problem. So the financial instrument has to work in this aspect first. Then, as we saw, there's not that much finance available for investments in general in the farming. We have seen the last figures of the financial gap in the sector. In Spain, the figure is around 8 billion. I think that the last number being presented here was like 6.5. Well, the issue is that there is a financial gap here. And there's a clear market failure here, which is that farmers or even developers of PPAs, they are asked fully collateralized operation. That means that they all are asked 100% of warranties for the investment required. And this doesn't match the real richness of these contracts. The real richness is not that. So, but banks and traditional financial providers are not making this analysis or these assumptions. They just want a full coverage of their loan applications, of the loan operations, and obviously these high collateral requirements as really a barrier for the development of PPAs and in consequence of the decarbonization of irrigation. So we designed a financial instrument with these things in mind. Okay, so how does this financial instrument works? Well, typically, a developer of PPAs, which normally is a specialized company with the knowledge on how to build large renewable energy facilities, 1-2 megawatts more or less is the average size. And this developer normally works with several different irrigator communities or large farmers or cooperatives, and using standardized PPAs, which is another important fact of our financial instrument. We provide a standardized PPA, which is related to the financial instrument. You have to use this PPA to be to qualify for the financial instrument for a number of reasons that I'm not going to deep into that, but it's part of the game. So this developer has to raise debt to build these facilities. Normally, in this sector, the debt is 60–85% of the total investment, depending on on the capacity of leverage of the promoter, and equity is the other part of the capital structure. And obviously, debt, because it's the most important part of the capital structure, is the target of this financial instrument. It would be great in the future if we have also financial instrument addresses to the equity part, but so far we focus in the debt part. So the financial instrument is a warranty for projects using PPAs for the debt finance of this project. So the bank has the warranty of the PPA. The PPA is owned by the special vehicle, and if something wrong happens, the bank can execute the warranties of the PPA, and the financial instrument will pay to the bank the failed loan to the special purpose vehicle. This is important because this financial instrument, the beneficiary is not directly the farmer, it's the investment vehicle. So this is a little bit of an innovation, but it's needed because in this kind of infrastructure projects, you need vehicles. You cannot, you have to isolate the projects and the richness and the financials. And for that reason, the beneficiary is directly the investment vehicle, not the farmer. as a result, there's more money for decarbonization of the irrigation, there's more affordable finance for PPAs, there's more, and the technology and the solution is more competitive. Obviously, in some cases, and especially in the current market circumstances, support to the interest, to the cost of the interest probably is needed too. And so it's in a combination of collateral and production in the cost of the interest is what makes this technology competitive in relation to the traditional energy sources, which is in the end what you want, because at the end of the day, the farmer is going to have two options. One, the price of the energy from the market with the volatility of the market, and B, the price of the energy from the PPA without volatility. So if the option of the PPA is not clearly better than the other option, probably the farmer is going to stay with the fossil fuel option, sadly. Okay, so very briefly, at the end, how this financial instrument works. You have a number of vehicles which are settled for these operations, and these vehicles and the irrigators, they subscribe these PPAs. Irrigators obtain their affordable and clean energy, and in exchange they pay to these vehicles the periodic payments, bills, like if they were paying to a normal utility company. So obviously these SPVs need finance for their operations, which are obtained by these loans from the banks, from the financial intermediaries, and obviously they have to repay the loans in the terms agreed. And here comes the financial instrument to the rescue, if needed, which obtaining funds from the managing authorities of the regions, from the rural development plans. They subscribe with José Ángel, the centralized financial instrument. They made their contributions and so on. And then José Ángel has a box there that he's been explained before, with SAECA there, which will pay to the banks in case of default. And that's the SolaQua financial instrument, more or less. Obviously, there's more subtleties there. So these are the banks, are the financial intermediaries. The final recipients are the SPVs, but the beneficiaries are the farmers. So because this is, there's also a methodology to assess the value of the PPAs and the business and a number of things that are part also of the financial instrument. Okay, so this, just to finish, this project is the result of a collaboration of different institutions, different stakeholders, including irrigators, including universities, including management authorities, and with the support of the European Commission. Thank you, European Commission. And so that's another thing that I think is interesting, to have this kind of framework for collaboration between different stakeholders to facilitate these kind of solutions. And so in this case, it was provided by Horizon 2020, but probably LIFE and other programs can also be used to develop these type of projects. And this is pretty much it, obviously. If you want to know more, we have our webpage. There's materials there. If you want to replicate this financial instrument, there's a lot of materials there, and we'll be more than happy to support you if required. So thank you very much.
Excellent, thank you, and thank you to all of our speakers. We now have time for a few questions, and I think I'll kick off with a few questions of my own, and then I will throw it out to the audience to see if anyone else has other questions. Janusz, let me start with you. You mentioned that establishing a good partnership with all the involved stakeholders is a key success factor to financial instruments. I'm wondering, can you maybe elaborate on how you create that partnership and how you see your role in creating that?
Yes. If we want to develop and run a financial instrument, there are a few players that we have to include. For example, we have the advisors, we have the financial intermediaries, we have units of public sector, the ones that process the payment claims of grants when the grants are combined with financial instruments. And of course, all these players have different levels of expertise, different level of knowledge of the subject. I do not include final recipients because this is a population that we cannot control or we cannot locate. I do not include the fund manager because we have everyday contact with the fund manager. But for all the other players, we consider ourselves as the source of support and to answer all their questions and to help them do their job better. In this context, we have done a few, let's say, I will give you some examples. We have provided a manual for the combination with grants. We have developed an IT tool so that everyone can calculate the gross grant equivalent and to decide if a reduction of the grant is necessary or not. We have published and distributed leaflets, posters, and we have created a mailing list of 3,700 advisors. I guess this is pretty much all the advisors active in Greece. And we periodically provide info and updates on the financial instruments. And we have done all these things. In concluding, we perceive our role as the ones who will help all the involved parties in order to implement financial instruments.
Okay.
And I have to say that the IT tool was developed in-house by one person, the former head of unit responsible for the financial instruments.
Okay.
Thank you.
All right, Marko, let's talk now about the final recipients. Can you talk to us a little bit about the communication strategy around this instrument? I mean, how do you promote and reach out to the farmers, to the agri-food processors? Can you elaborate a little bit about that?
Thank you. Well, at the first, when we started implementation of the financial instruments, as I said through the presentation, we had really strong media campaign. So we were present almost everywhere in Croatia, every part of it. We had a series of workshops dedicated to the financial instruments and its benefits, to present it as a new tool for our farmers and other entrepreneurs in rural areas. And one of the first workshops was similar to Greece. We had it for the advisory service. So because they are the first contact point for every farmer that is interested into financing its products through its projects to FIs. So we are still present. We of course have media campaigns throughout this period, but once you get the financial instruments rolling, I think the best word of recommendation is by happy receivers of the financing themselves. They talk to their neighbors, to their friends to their colleagues, and I think that is the reason that the high demand was present throughout the years. We practically don't feel any lack of interest for financial instruments.
Okay, and on a similar theme, José, let me turn to you. How important do you see the promotion of... Sorry, do you have the interpretation? Yes, good, okay. How important do you see the promotion of the instrument, and what is your engagement like with the participating banks? Okay, I'm going to get my headphones.
The microphone is off, unfortunately.
Yeah?
Yes, indeed. Well, promotion is essential. It is key. And this has been one of the main lessons learned through the previous period from 2014 to 2020. It was key in reaching out to the final recipients and being in contact with the financial intermediaries. Regions have established awareness-raising activities so that everyone gets to know the instrument, and as representatives of the ministry, we've also published diagrams with days to give more information on the instrument. We've been in contact with representatives from other autonomous communities. We have training courses that are also aimed for technicians from autonomous communities, especially those that are new to these fields. We want to continue raising awareness. We've also developed a quick manual for the directors of financial institutions and banks, because it's true that at the offices and banks, you may have a manager that has 30 different tasks to respond to. We wanted to have a quick guide on these financial instruments and how they can be managed. We've developed that guide, and of course, we continue to develop other possible material. Thank you. Was there anything else?
Thank you. And Julio, let me turn to you for a question before I throw it out to the audience. So of course, you were describing a very specialized instrument here, but do you think this kind of instrument could be used beyond solar irrigation, or maybe there's some transferable kind of knowledge you think that could also be transferred to other instruments, beyond the catchy name? other ideas that you could bring from this?
No, definitely. As I said, if you need investments for decarbonizing your industry in the farming sector, in any other sector, you probably need power purchase agreements because that's what is needed to opening access to funds, not only to loans, also to equity. So,
hold the mic, yeah.
Okay. So solar irrigation is a very obvious first shot because of this, the volume of the investment, and also the fact that you have very reliable cash flow stream, which comes with the PPAs. But as long as you have that two things, a high upfront investment, I mean, at least €500,000 or so, otherwise you probably don't need a PPA. And a reasonable, stable, and predictable future cash flow, then this or a variation of this is the kind of instrument that you will need. For example, biogas or even electrification of certain processes, energy efficiency, that kind of investment, and as I said, not only in the farming sector.
Okay, Thank you very much. Let me just throw it out to the audience. And so that very nearly brings our event today to a close. And for the closing remarks, I would like to welcome to the stage Bruno Rubino, who's the head of the Fee Compass at the European Investment Bank, for your closing remarks. So the floor is yours, Bruno.
Thank you, Natasha. Ladies and gentlemen, we're leading towards the end of this conference, and I really hope you enjoyed the different sessions, which I must say they were quite dense and diversified in terms of contents. So don't expect for me in less than 5 minutes to condense all the key messages of the 15 distinguished speakers which preceded me. But I would like to make a couple of considerations now at the end of this event. What stands out is that financial instruments have been proved to be a powerful tool to support farmers, would that be small farmers, young farmers, agri-holding, food processor enterprises. We heard today that financial instruments, or when it comes to access to finance, financial instruments are extremely important, but that there are still a lot of gaps depending on the different member states. You heard that. There were a lot of figures, a lot of statistics about that. So market gaps are still important in the, when it comes to the agriculture and food processor sector. A lot has been done in the last 7 years, but as a function of the growing needs, and today you heard that there are more and more needs from the farmers, there is still a long way ahead to us. And this long way could be facilitated by the adoption, and here allow me to quote the Commissioner, by adopting well-designed financial instruments. My consideration, my message is to the representative of the managing authorities, EAFRD managing authorities, and in particular to the ones which have not yet been exposed to financial instruments. So I really hope that the different sessions of today, in a way or the other, have somehow inspired you. What is important is that in adopting financial instruments, you could benefit from the flexibilities offered by the regulation, which include, among others, and not limited to, and today was not probably said enough, the finance of working capital, the purchase of land for young farmers, and the combination of financial instruments and grants in one single operation, and in one single instrument. As the EIB Vice President said this morning, you will not be by yourself in this journey. The advisory team of the EIB, together with the colleagues of DG Agri, are ready to support you in this journey, are ready to support the managing authorities who have decided to look into financial instruments and hopefully in the future maybe make good use of these new opportunities. Building on the working knowledge of the financial instrument accumulated so far, Fee Compass can provide specialized support to the managing authorities interested in exploring the different possibilities, the analysis and combination of the different sources of financing, with a view to get more liquidity into the market, and we saw that today that there is a huge need for that, and maybe, whenever possible, to de-risk the financial operation through the instrument that we saw today. Well, ladies and gentlemen, let me conclude by thanking all the speakers of today for their efforts and for presenting their achievements so far. Special thanks goes to the colleagues of DG Agri and to the EIB advisory team, which is behind this conference, and especially the team that you don't see on stage, which is they're in the background, they're somewhere over there. So thank you very much for the preparation and the good execution of this conference. Allow me one comment. We are in the 9th edition of this annual conference, which confirms, I would say, the good and strong collaboration between DG Agri and the EIB. So it's a very solid partnership. And more than 150 participants today in the room also witness the fact that there is a growing interest for agriculture financial instruments. Let me remind that the survey is on financial needs and access to finance for agriculture and agri-food enterprises. And by the way, all the videos that you saw today are available on the FICOMPAS website. Finally, let me thank Natasha for a smooth moderation today. So big applause to Natasha. And I would like also to thank the interpreter. Thank you very much. Well, after having said this, I hope to see you in future FICOMPAS event. And well, have a nice end of the day and safe trip back. Thank you. Natasha, over to you.
Thank you.
I'll stay here.
Well, yeah, if you'd like. Well, thank you very much. Thank you, Bruno. Let me echo your thanks. Thank you to all of you in the audience. Thank you to the panelists, to the interpreters who have been doing a tireless job over there in the back. Thank you. Yeah, exactly. They deserve a clap. Yes, I agree. I agree. Yes, thank you very much. It's been a pleasure to moderate this session. I will just reiterate that it would be great if you could fill out a survey with your feedback. You can do that. Oh, yes, there's the QR code. You can do that through the app, this QR code. There's also the old-fashioned way with paper, if you'd like to. There's so many ways to do it. Please do that. That would be excellent. The recording of this conference will be available in the coming days on the FICOMPAS website, so look out for that if you would like to have another look at some of the sessions. And thank you very much. That brings it to an end. It's been a pleasure. Have a lovely evening, and thank you to all of you. Goodbye.